Flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures sinking today after President Trump imposed tariffs on Canada, Mexico, and China in the most extensive act of protectionism by a U.S. president in almost a century, a sweeping 25% tariff on Canada and Mexico, taking effect tonight at midnight. Meanwhile, China tariffs and Canadian energy will only receive a 10% levy. The president told reporters last night he plans to speak with the leaders of Canada and Mexico today.
Plus, investors will get the latest reading on Magnificent Seven trade with earnings from Alphabet and Amazon this week. Alphabet is set to face some questions on how it will mitigate the cost of developing its AI tools in light of DeepSeek's emergence. And for Amazon, strong demand for its cloud services is expected to boost results.
And rounding out the week will be the January jobs report. Payrolls are expected to show a solid pace of hiring for the month prior. Here, the consensus estimate on Wall Street, 170,000 jobs to be added during the month of January. That compares with the December jobs report, adding 256,000 jobs.
U.S. stock futures plunging this morning as President Trump announced his plans for sweeping tariffs on the United States' largest trading partners. Taking a look at the stock market reaction, here we are 29 minutes ahead of the open. You are looking at losses across the board. You've got the Dow set to open off just about 1.5%. Same goes for the S&P. We're looking at the NASDAQ under pressure here, off just about 1.7%. So again, pressure across the board on the heels of these tariffs that were announced. 25% additional tariffs on imports coming from Canada and Mexico. When you take a look at the 10% levies, there were also additional levies here on China, clearly having a ripple effect across the markets. Let's take a look at the currency board. You're taking a look at the dollar. You got the dollar strengthening on the back of this, something that many on the street had expected if we were to see sweeping tariffs like this. You're looking at the dollar gain here up just about 0.8%. You're looking at the highest level that we have seen in quite some time here. The rise of the dollar, we're also seeing that impact here on the Canadian dollar and also the Mexican peso. Both of those values dropping just a bit. So the U.S. dollar strengthening on the back of this. Something to note here. We're showing this to you just because this really does exemplify some of the pressure that Canada and Mexico will be under right now because of these sweeping tariffs that could be imposed at midnight tonight. So again, you're looking at the Canadian dollar falling in relation to the U.S. dollar strengthening and also the Mexican peso. Flipping over to the crypto market, that's also feeling a bit of pain here this morning as more uncertainty is introduced here for the broader market. You're looking at Bitcoin now below 95,000. So certainly you're seeing the ripple effects play out. And Brad, on a sector basis as well, when you start looking at specific names, you're clearly seeing some of the worry there play out in the market.
Yeah, two areas that I'm paying close attention to as well here. Let's take a look at the commodities and oil market to start things off. Of course, that's going to be in focus here as you're taking a look at a rise for both Brent and WTI, but also kind of zeroing in further on some of the sectors here and names moving off of tariff risks this morning, specifically looking at autos here. And I was taking a look at some of the data that was published on social by Callie Cox, who we're going to have on a little bit later on in the show, talking about the percentage of affected goods in auto vehicles and parts here, 53%, so a little more than half there. And this is where we're taking a look at some of the automakers, because this would impact how that production goes forward, especially for some of the materials that need to be sourced. You think about what S&P Global had already put out last week, talking about January U.S. auto sales estimated to hit 1.15 million units, an estimated sales pace of 16.2 million units. This could ratchet up the prices for automobiles and ultimately put a dampener on that overall projected figure for the year here. And so one of the things that we're kind of expecting going forward from here, especially as you're looking at GM, Ford, and Tesla already beginning, at least investors, to factor in that that could be a hit in near-term consumer sentiment and ability to purchase if we did see vehicle prices move higher. And then additionally here, we got a reaction out of one of the transportation names here too from Loop Capital. They got some downgrades this morning, the transportation names on tariffs. FedEx, CSX Corp, Norfolk Southern, and GXO as well, logistics, all cut to hold from buy at Loop Capital. And they said within this report, essentially the USMCA, the US, Mexico, Canada agreement is dead. That was in their note. And they said, assuming all the tariffs go ahead, it feels like we're at the beginning of an insanely expensive experiment that is doomed to failure here. With the duties scheduled to go into effect at midnight, they go on to write, that means US Customs and Border Protection will start assessing and changing import duties at 12:01 a.m. Eastern time here. So as every plane lands, ship docks, truck and train arrives, that's also going to be a cost that gets transferred on to the consumer most likely here. And so there we were taking a look at some of the shipping names that were part of that Loop Capital call there. And then just lastly here, you had some earnings results actually out from Cleveland-Cliffs this morning. They had mentioned that 2024 was essentially the worst year for domestic steel demand since 2010. This is one instance, and you might hear this a little bit more, where if these tariffs go forward, there are going to be some companies that look at this as an opportunity for themselves to be more relied upon for their goods. And so they mentioned, because this is the largest supplier to automotive industry in North America, we should note, they mentioned that so far in this year, they've already seen improvements in their order book, more reliance on Cleveland-Cliffs as the rest of the world, at least in US and Canada, get cut off from some of what Cleveland-Cliffs is able to put further into the market as well.
Yeah, and that's only scratching the surface on the impact that we could see on individual names as a result of this. And I think very much so you can see the broader concern right now being reflected across the markets. I mean, you take a look even past some of these consumer-facing names or names that you maybe would first come to mind when you talk about multinational names that are under pressure here because of the dollar. You've also got big tech on your screen. You mentioned Tesla, Amazon, Meta under pressure here, but when you look inside some of those chip names, NVIDIA among the decliners here this morning. You're also looking at Broadcom, another name within that sector here, also posting losses here this morning. Qualcomm was off just about 2% as well. Applied Materials, Micron, ARM, Intel, Texas Instruments, the list goes on just in terms of the pressure that we're seeing across chip stocks as you're looking at tech, one of the biggest contributors here to the decline this morning. And then energy stocks, so much focus here on what ultimately this is going to have, the impact that this will have on the energy sector. The 10% tariff against Canadian oil imports came as a bit of a surprise. I think much of this came as a surprise, but this very much did come as a surprise here to the market. You're looking at the at crude and Brent also trading to the upside. You're also seeing those ripple effects play out across energy stocks as well.
All right, well, President Donald Trump raising the threat of tariffs on the European Union, saying on BBC they will come, quote, pretty soon. This after Trump signed executive orders to impose 25% tariffs on imports from Mexico and Canada, with a carve-out for energy from Canada getting a 10% tariff. And of course, China imports will receive an additional 10% tariff. When asked about the impact of tariffs on the consumer, Trump had this to say.
We may have short-term a little pain, and people understand that, but long-term, the United States has been ripped off by virtually every country in the world. We have deficits with almost every country, not every country, but almost, and we're going to change it.
Joining us now to lay out the landscape ahead, our very own Rick Newman. Rick, you were putting pen to paper and publishing on this over the weekend here. What have you found?
Here's something interesting. Markets did not think Trump was going to impose his full slate of tariffs, and they still don't think this is likely to last long. So I'm seeing some analyses this morning saying, hey, this might be a good chance to buy the dip. Trump's tariffs probably are not going to last for more than a few days or a few weeks. So there still is this expectation that this is a bargaining tool and that Trump is going to get something from this and he's going to remove these tariffs. Is he going to do that? I have no idea. I mean, I think part of what Trump is trying to do here is create uncertainty. He doesn't really want people to know what he might do in the future, but there is still a bet that these tariffs are temporary, not permanent.
Rick, the uncertainty that this introduces to the market and the impact that we're seeing almost across the board when it comes to some of these industries that have exposure, obviously, to these tariffs, how much of that do you think is going to then play into the administration's decision as to whether or not these tariffs do go into effect tonight at midnight at the scale that has been announced, and then also, obviously, the impact that it's going to have on the longevity of them?
Well, nobody is sure, but I mean, people reading the tea leaves are saying, look, Trump is very sensitive to markets. I don't think he necessarily cares about the stock of any given automaker, the stock price of any given automaker, but he does care about the direction of markets. And if there is a sustained sell-off, that could be the type of thing that gets Trump to back down. You know, this is the sort of the madman Trump we're seeing. How far will he go? I mean, he clearly makes these threats. I mean, we know this from his first term in office. You know, he imposed tariffs mostly on China, and then he got China to make a deal, and he backed off on some of the tariffs. I mean, he left some tariffs in place, but that, you know, he backed down on the bigger threat. So how long is this going to go on? I wish I had a better answer or more soothing answer for investors. But I mean, this could go on for some time because Trump wants something, and we have to see what it's going to take to satisfy him, and we don't really know.
Rick, thanks so much. We're going to continue to track, of course, some of the activity going into the open here and continue the conversation here as well. Canada has already announced retaliatory measures with tariffs on $155 billion of goods, U.S. goods, including food, alcohol, consumer products, and materials. Joining us now, we've got Terry Haynes, Pangea Policy founder here. And Terry, I guess that's, of course, the crux of this. It doesn't just come down to what the U.S. is imposing, but also what is retaliatory and the scale of that as well. I would like to get kind of your gamesmanship as to how this plays out from this jumping off point.
My gamesmanship, Brad. Good morning. My gamesmanship, generally speaking, is that Trump judges this as being an advantageous time to pursue what I think of as geopolitical goals, including getting Canada's and Mexico's help to seal the border and to stop the flow of fentanyl into the United States. So those, and beyond that, there's a situation where he's interested in balancing trade a little bit more. You know, a lot of my Canadian sources say that, I mean, not only do they say that it's a advantageous time for the United States, but point out that that Canada really can't withstand in the long term a sustained tariff regime. So I imagine what we get here is possibly some mitigation of the tariffs if Canada and Mexico come up with more specific ways in which they can help the United States achieve its goals on border and fentanyl.
Terry, the market sell-off, similar to the one that we're seeing here ahead of the bell this morning, is that going to be something that will be enough to get Trump to back off?
No, absolutely not, Sean, and good morning. You know, the way Trump looks at this, I think, based on his statements and public statements of him and the administration, is, and his experience post-2016, is that, you know, the markets are with him on a lot of what he wants to do on economic policy. So a small downturn isn't going to bother him. I mean, you got to remember that tariffs are part of a much broader economic policy, the vast majority of which markets are really hungering to get, whether it be tax cuts, whether it be increased energy production, regulatory reduction, spending cuts, all those sorts of things. So, you know, tariffs as in a silo looks like a downturn. Tariffs, the way that Trump and his folks see it, as part of that broader economic policy, I think is they see as markets plus, and I think markets do too.
Terry, how do you see the negotiations right now playing out behind the scenes? Obviously, Canada has already said they plan to retaliate here. Trump administration's figuring out exactly what that tariff strategy looks like here as we do approach midnight. What do you think those conversations are like, just given the fact that we have gotten some conflicting messages when it comes to the belief, I think we can say, in tariffs from the Trump administration?
My instinct is that what the United States will want are very specific pledges from Canada and Mexico about what they're willing to do to help seal the border and close off the flow of illegal drugs, and need to back that up as well with an awful lot of specifics, including resources, manpower, and the like. The more specific they get, the more likely Trump is to be satisfied. I will say also, though, to Rick's point earlier, that I think, and this is instinct on my part, but I think Trump probably decides to keep them on the string. In other other words, lessen the tariffs, but not eliminate them entirely. As I say, you got to understand that tariffs for markets is much bigger part of both economic policy and of geopolitics, that markets have successfully avoided having to think about that much recently, and they're going to have to start thinking about it a lot more.
Terry, we only have 30 seconds, but you've got some souring opinions on Wall Street now. Big banks trying to figure out how friendly or foe-ish Trump is to business. Is he business unfriendly if tariffs continue to move forward at the velocity that, again, we're just weeks into the presidency, at the velocity that we've heard them be talked about and prioritized?
Well, Trump would say he's not, that he's the farthest thing from it. I certainly know Trump apologists, but I would tend to agree with that by and large. What the vast majority of what Trump's trying to do, which I described to Shauna a minute ago, is very business friendly, and business sees it that way. So I doubt that sentiment's going to turn wholly against Trump on this.
All right, Terry, always great to get your insight. Thanks so much for taking the time to join us here this morning. Tariffs on Mexico, Canada, and China expected to have a significant impact on the U.S. economy. J.P. Morgan also warning about the impact that it could have on Mexico and Canada, could potentially threaten to throw those two nations into a recession. Joining us now to break it all down is Steve Risciuto. He's Mizuho America's U.S. chief economist. Steve, let's focus this conversation around the U.S. economy, at least as a jumping off point. How concerned are you as an economist just about how this all plays out, the ripple effects, the inflationary aspect of these tariffs?
Well, I honestly think the inflationary aspects have been somewhat overplayed, not just because the 2016 tariffs, the 2018 tariffs didn't have the effect everyone thought it had, and not because you don't understand the economic theory that tariffs should raise the cost of a product, but you have to put it in a global context. And we have a global economy which is substantially weaker today than it was in 2018. We have a greater degree of excess supply, a greater degree of global disinflationary environment. We've had inflation remaining very, very benign in an environment where the Federal Reserve has shifted its focus away from inflation to maximizing full employment. And you have a currency that is appreciating. So I think there's a combination of margins and currency that will wind up absorbing a vast portion of the adjustment in prices. Now, if you want to get into whether or not there's macroeconomic ramifications from this, to be honest with you, you got to look at the policies of the administration in total to get a sense for that. And I think people have been too cautious in their approach to Trump, thinking that, Trump is going to do things around the margin, and he's not going to go bold and he's not going to go big. And the reality is we've been assuming he's going to go big and bold day one initially, and he continues to not surprise us. He's doing what we suggested, thought he would do. But it's very, very surprising to the street, which is amazing to me because he campaigned on this.
We had seen, of course, in the Trump 1.0 administration, the entire tariff play out with China, and ultimately a deal that came through, but a larger question mark because of the timing of it going into the pandemic. The actual execution on the elements of that deal, they'd seem to get pushed off for a while. So what is the likelihood that whatever nets out in an agreement with U.S. and Mexico and U.S. and Canada, and then U.S. and China as well, that we see elements of those deals be followed through and actually kind of held accountable for all countries?
I think you are going to see them hold people accountable. I think this is a real deliberate profile to make sure that things are done and things are followed through, and promises that are made are kept. This has been one of the big issues that the administration has had with prior agreements and prior discussions. This goes even to the NATO situation, where the administration wants people to keep the promises that they make. The assumption is we keep our promises. We want you to keep your promises. Now, people could sit back and say we don't keep our promises. Again, there's arguments there on both sides of it. But the reality of the situation is right now, Donald Trump has the levers, and he's going to push them. And people should not assume just because of the person he picked for Treasury Secretary, that's going to change the approach to fiscal policy. And this is part of his fiscal policy profile.
Stephen, real quick, for the Fed, going to keep them on the sidelines for even longer?
Well, I mean, I think the Federal Reserve, again, will depend on the data. I don't think it's necessarily keep them on the sidelines for any time longer. I think and I don't think they should have cut rates at all to begin with. But I think the situation is they're going to assess the labor market and they're going to make an assumption based on the labor market. And if the labor market weakens, I think the Federal Reserve would respond more quickly than if inflation went up by a couple of tenths.
Stephen, thanks so much for taking the time here with us this morning ahead of the opening bell. Appreciate it. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. Looking beyond tariffs, a busy earnings season continues this week with Magnificent Seven names, Alphabet and Amazon reporting results on Tuesday and Thursday. Here to discuss, we've got Mark Mahaney, Evercore ISI Managing Director and Head of Internet Research. Mark, it's good to have you on the program here with us this morning. You know, as you look into the magnificent earnings this week and what these two particular companies are set to tell us about the health of the Mag 7 trade, what are you going to be listening for?
I think three things. First is whether the DeepSeek implications or whether there were any DeepSeek implications. A week ago, Meta's Mark Zuckerberg had a chance to answer that question, and he said, it's intriguing, it's interesting, we're going to study it, but we're still spending $65 billion this year in CapEx. I would expect similar responses from Amazon and Google that they'll study any innovations, but they plan to lean aggressively into investments. So I'm looking for confirmation of that. Secondly, any sort of commentary about tariffs. I don't know that there's really much to say. I think both of these companies do have exposure to it. Obviously, Amazon. But Google too, and Meta, and all the large cap names that get money from marketers who are marketing cross-border trade, which is a significant source of revenue, solid mid-single-digit % of revenue, maybe high single-digit % of revenue. So there'll be some impact here. They'll probably talk about it. And third, just overall demand trends, and we think Google will be able to talk positively about ad trends like Meta did. And with Amazon and AWS, Microsoft gave us kind of a mixed read on demand there. Not necessarily better, not necessarily worse, solid, but not necessarily improving as quickly as the market wanted or as well as the market wanted. So the question is whether AWS is going to show similar trends as Microsoft did. We think they will. They did 19% growth for AWS last quarter. If it's 20% this quarter, great. It's 18% bad, 19%, which is what we think it's going to be. It's going to be kind of neutral.
Mark, let's dig into those 3 points and start off with the first one that you highlighted when it comes to whether or not we're going to hear, and very much we're expected to hear, these larger companies continuing to spend and spend at scale on AI. From an analyst perspective, is that the right approach, or does DeepSeek maybe cause you to reevaluate that strategy and that playbook then going forward?
I don't think it causes us to reevaluate it. And if somebody comes up with great efficiency hacks, I mean that in a really positive way, like somebody figures out a way to run these large language models at materially lower compute power, then I think it's a win for these companies, particularly for a Meta that's not selling LLMs, that doesn't have a big infrastructure business. So if you're reducing their costs, it's great for their margins long term. The real question is, as we dig deeper and deeper into this, is just how high is the quality of the DeepSeek language model, and some security problems are starting to pop up when it comes to DeepSeek. So we'll see whether they're real breakthroughs or not. But anything that brings efficiency gains, again, allows people to run these large language models, their AI models, at lower cost, is generally very beneficial for these 3 companies. And I think that's probably the tone that management's going to give when they talk, both Amazon and Google this week.
Mark, of course, early week and over the weekend now, we're considering how the markets are ingesting some of the tariff talk that's commencing. Does that create a dip buying opportunity, as we certainly have seen this pullback in some of, across the market, but some of the big tech names as well?
We may. It's going to be, depending how big of a dip. The truth is that most of the large cap tech stocks I look at are kind of deep consensus longs. They're at the upper end of their trading range, upper end of their valuation range. The only large cap name that's kind of dislocated, what I call DHQ, dislocated high quality names, is Uber, which actually reports this Wednesday. But the bar is high for these names. The fundamentals have generally been very strong. I mean, these companies are putting up record high operating margins and no real deceleration in growth. It's really, really impressive. Fundamentally, these companies looking to be in a really good position. It's possible the tariffs kind of knock them down a little bit. I don't know if it's going to be a dramatic knockdown. And look, if there were a material correction in these stocks because of tariffs, assuming that they're going to be somewhat short-term in nature or medium-term in nature, yeah, that would be a dip you buy. But you're talking about a dip from kind of all-time high levels here. So to make it really attractive, you need a substantial dip. I hope we don't get that, and I don't think we will either.
Mark, who is most exposed to that tariff risk?
Probably Amazon, just as a company that's so most geared, but not just towards Chinese imports. I mean, so much of trade is cross-border with Canada and Mexico, and so to the extent that hurts manufacturers, retailers, well, it hurts the platforms that manufacturers and retailers look to sell and to market. So that would be Amazon, it would be Google, it would be Meta. So this will take some time to kind of work its way into the systems. But I'd probably put Amazon as the most exposed of those 3, and then Google and Meta probably equally exposed.
All right, Mark Mahaney, always great to get your thoughts and insight here, especially ahead of a week like this week. Thanks so much for taking the time to join us. Keep right here on Yahoo Finance. Much more of your market action ahead. We've got the opening bell when we come back.
There you're taking a live look at the opening bell. We've got a look at the New York Stock Exchange where you've got M&T Bank celebrating Black History Month. Happy Black History Month. And you've got Twin Peaks ringing the opening bell at the NASDAQ. Let's take a look at the major averages. To begin today's trading activity, we are down across the board here as markets digest the latest announcements around tariffs and tariff talks coming forward between the U.S. and Canada. It sounds like they were going to be speaking later on this afternoon. We will see what those developments entail. But as of right now, to kick off today's trading session and the first trading week of the month of February, we're taking a look at the Dow Jones Industrial Average down by about 1.25%. Also take a quick gander at the NASDAQ Composite. You're seeing that down by about 2%. Let me populate this chart for you here. We'll just give you a little bit of a look at what the activity has looked like coming into the start of today's trading activity. And the S&P 500, you're seeing that down by about 1.6%. We'll round this off, make this a 5-day look here. And then additionally, taking a look at those S&P 500 11 sectors, we've got them pulled up here on the board for you so you don't have to go looking for them yourself. Technology pulling up the caboose out of the gate here this morning. That's down more than 2%. And yeah, you've got a sea of red. 11 S&P 500 sectors, 11 S&P 500 sectors in the red. Let's take a look at the NASDAQ 100 since technology is the worst of the performers out of the gates here this morning. Those mega cap tech stocks, we got them zeroed in for you. We've got some Lake Red, some Maroon 5, if you will. NVIDIA, that's down 5% to start off today's activity. Apple, Google, Microsoft, Amazon, Meta, all also in the red. And Tesla, taking a look at shares there, down by about 4% out of the gate here. And then just lastly, I'll ride out with a look at the Dow 30 components just to see how we're faring there. You still got some spots of green on the table here. United Health, that's higher by about 0.7%. But let's also populate this chart just so you can see exactly what's been taking place over the year-to-date scale. Yeah, we're up by about 7%. Okay, but the worst of the performers here again, NVIDIA, and also you've got Nike, the swoosh. It is not swooshing to the right side right now. Anyway, shares are down by about 3%. Let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving a little bit deeper. Jared?
Thank you, Brad. We've got some broad themes here that we're talking about after the tariff imposition, and we're seeing weakness in tech. We're also seeing weakness in some other sectors and also the small caps. And we'll get to retail in a minute too. But here's the Russell 2000. It's down 2%, leading the majors down. I'm going to put a 3-month chart, or let's put a 3-year chart on this so we can see exactly how it has been trying to peak and poke above those prior highs there. But overnight, I would add that the Russell 2000 was down 4%, so it is off of those lows, and I'm going to be watching the 200-day moving average. It's somewhere down here. That's going to be a key level because that's where it bounced off of overnight. And then in the Dow, let me put a 1-year chart on so we can see what we're up against. We came within 20 points of a record high on Friday, failed to take that out, and so now you got the double top crowd saying, well, we might be in for one. Too early to tell. So we could have this resolve to the downside. We could also see new highs, but that's just something that's on our radar right now. I want to take a look at the US dollar index. This is a broad trade-weighted index that has been around since the 1970s. That is heading higher. Here's the overnight price action, and I'll put a multi-year chart on here too so you can see what we're up against. We are pressing up against these highs that we had late last year, early this year. Haven't exceeded them, but if we do, that is going to be a multi-year high. And that is the dollar wrecking ball knocking on the door again. That was a pretty big jump overnight, so we do want to take some time and be prepared for that. We got to take a look at the sector action. Once again, everything in the red as Brad was just going over. We do have Meta and XLC, that's communication services here. Communication services was on a 10-day run to the upside. Looks like it's in danger of breaking that right now. And then if we head over to the NASDAQ, I did want to point out NVIDIA. NVIDIA is also testing its 200-day moving average, and now it is sunk below. This is a 1-month chart, and the 200-day is somewhere in here where I'm drawing, not precisely, but it is down there. So a close below kind of puts the AI trade maybe in a little bit of a doubt right now. As it is the nature of a bull market, though, we have sector rotation. So you want to see other sectors picking up, even if it's not today. Here is the crypto market. We're also seeing some weakness in Bitcoin. And Bitcoin is one of the least bad off right now. This is a 1-month chart. Let me put the 1-year on there and you can see, well, you can't see that right now. Let me put a 3-month and see if we can show you where we are with respect to these record highs that we saw last year. We are just in a giant trading range, but now overnight we hit 91,000. That is the lower end. So we do not want to see 91,000 broken to the downside. That could portend some more weakness. But what I got to point out here is the tremendous weakness that we're seeing in some other tokens and cryptocurrencies. Ethereum, that's down 15%. Dogecoin, that's also down 15%. ADA, that's Cardano, that's down 22%. So we're seeing a lot of weakness, not just broadly, but especially in some of the smaller tokens. And that just points to the risk-off flavor that we're seeing in the markets right now, Shauna.
Certainly are seeing that right now here at the Open. Jared, thanks so much. It's time now for today's strategy session. U.S. stocks moving to the downside at the open as tariff risks does spur some selling on the street. Joining us now to break it all down, we want to bring in Callie Cox, Ritholtz Wealth Management Chief Market Strategist. Callie, I think a lot of investors are looking at the reaction this morning, a bit surprised maybe about how the tariff scenario played out over the weekend here. We talk so much about it, still seems to catch Wall Street off guard just a bit. What are the trades that investors need to keep in mind this morning here at the Open?
Clearly, the trade is sell stocks here. And according to what I saw a few minutes ago from your colleague, this selling pressure is happening really across the board. And to me, that reads as something where people aren't asking questions first. They're just they're selling. And I think that's fair to do right now because tariffs have far-reaching effects across the economy. I want to remind people, though, we still have a good amount of time before these tariffs actually come into effect. And the news is moving so quickly. So I wouldn't be so sure that, tariffs are going to happen and are going to last for a while. But when I look at what's happening, Shauna, I have to assume that, especially when we're talking to clients who have those longer term perspectives.
Right. And markets usually try to look out into the future, months into the future as well here. But we do know for the tariff component, at least, I guess from your own kind of estimation and kind of looking back at previous instances where we've seen tariffs actually be enacted, what is that lag time like? Because markets are going to look out into the future, but the time to which the pricing actually filters through to the consumer and then has a longer ranging impact that the markets have to factor in, what is the calculus around that?
This is the tough part. We don't really have historical precedent for this severity of tariffs. Obviously, we have 2018 and 2019, but those tariffs were peanuts compared to what could come into effect tonight at 12:01 a.m. I don't think this is necessarily something to wring your hands about. I think, if you approach it strategically, you could find that you have some agency here, Brad. And what I mean by that is, right now the tariffs are targeted to be on Canada, Mexico, and China. I don't hear any developed markets or European markets in that list that I just rattled off there. And I know international stocks aren't the sexiest place to invest, but I think if you're, trying to target a hedge here, I think European stocks are the place to look.
That's interesting there, Callie. And then also, I guess you also have to factor in just how real that risk is that we could see tariffs implemented on the EU and then the pressure that could ultimately put on some of these European stocks. When you take a look at the strength that we're seeing this morning in the dollar, how problematic is that for some of these multinational companies?
Very. So short answer is very, especially with the dollar at a multi-year high. And we don't know if the dollar stays here, of course. It's been volatile. It's been very volatile lately. But when you think about it, the biggest companies that many of us own, the big techs of the world that are selling off hard today, pharmaceutical companies, industrial companies as well, they have a lot of exposure to international markets. So I think you have to be a little picky here. You have to understand exactly, what the tariff effects could be. I think the biggest effects will be on automakers. I think it'll be on, food production and resellers, potentially retailers. But, you have to be smart about this. And part of me wants to say that, we might not see a market reaction until we see these impacts show up in earnings. But we are in earnings season and the dollar has been strong for a while. So I think you have to be a little more skeptical and a little more hedged, heading into this particular round of earnings.
Callie, just while we have you here, a lot of investors that will try to flock to or seek out safe havens in a moment like this. Where do those opportunities and the safe havens at least emerge from your evaluation?
Well, if you're worried about inflation, you have to look at the tangibles, right? You have to look at gold. You have to look at, inflation-linked Fixed income, for example, TIPS have had a really good 12 months, and I think there's a reason for that. U.S. bonds are holding up, or treasuries are holding up pretty well today. I'm not sure if that continues because, of course, there are a lot of questions around what this could mean for, the future of the systems that we rely on. But, I think gold is the obvious trade here. And, you really have to consider having a lot of diversification. We hate the D word, but a lot of diversification in your portfolio just because the effects of these tariffs could be vast.
Kelly, since you did bring it up, the bond market's reaction, I think, has been a bit perplexing, confusing here, especially when you see sort of it being pulled almost in two different directions. What does that then signal to you?
Well, I'll admit it's been quite perplexing to me too. The 10-year yield has risen quite a bit because there have been a lot of questions around future policy from the Fed, from the government. I don't think tariffs quite help here, even though the 10-year yield is down about 5 or 6 basis points right now. I mean, there is that built-in uncertainty when, people are, looking at fixed income 10, 20, 30 years down the road. I think rates stay high here. I think that there's a higher base unless we see the economy fall apart or if we see the job market weaken pretty quickly, which is certainly a possibility. But I think right now you have to be smart about the duration risk you're taking, what maturities you're looking at in the fixed income market, how quickly you're investing that money out that you get. And, quite frankly, looking at your cash levels, because 6 months ago, sitting in cash was pretty illogical. Right now, sitting in a little bit more cash might make more sense. But I also don't think you stop investing here. There are just way too many questions to do that.
Callie, thanks so much for the time here this morning. I referenced your chart that you posted on social media, of course, with the affected goods. So I appreciate you sharing that across social. Thanks.
Yeah, thanks for having me.
Absolutely. Time now for our chart of the day. Let's send it on over to Catalyst's co-host, Madison Mills, for a look at our top trading partners for oil. Hey, Maddie.
Hey, Brad, that's right. So we are seeing a huge move when it comes to the oil market today, and that is because of the potential impact that these tariffs could have on energy here. It's interesting because you might think the U.S. already has a ton of oil, and we do, but we're still importing from Canada and Mexico, our top two trade partners when it comes to crude, specifically because our refineries can utilize crude that is a little bit heavier from Canada, from Mexico, to be able to refine that oil into the type of oil that can typically be used for diesel and jet fuel. So that is why we still utilize those trading partners here. And the anticipation is that because of these tariffs, the price of oil is going to go higher here. Refiners in the U.S. are then going to push that cost off to consumers. We've already heard from Canadian oil companies this morning, Irving Oil, for example, saying that they will definitely be passing that cost onto consumers. So hearing that from the Canada side, we import about 4 million barrels a day from Canada specifically. Now that's a 10% tariff on Canada, so not as much pain as a percentage there. But even with Mexico, we import about 500,000 barrels a day. That's going to be a 25% tariff potentially if this does start to go into effect at midnight tonight. Of course, we're continuing to get headlines in this morning from the Trump administration speaking with officials from Canada, for example, about what those tariffs could actually look like. But that is the base case here at the moment. I just want to end by saying Gas Buddy has already pointed out this morning that the cost of oil was already ticking up ahead of these tariffs. And now any potential tariff here could, of course, continue to move that further to the upside, guys.
Certainly one of the worries here for millions of Americans. All right, Maddie, thanks so much. Coming up, tariff fears hitting chip makers and semiconductor equipment makers. We'll discuss the threat to the tech sector next. Chip stocks are falling this morning after President Trump has hinted more targeted tariffs could come to semiconductors in the wake of sweeping levies against China, Canada, and Mexico. We want to bring in John Vinh. He's KeyBank Capital Markets equity research analyst. John, it's great to have you here. So certainly we're seeing a lot of these chip names caught up in the selling pressure here this morning. Tech, one of the biggest contributors to the declines that we're seeing here shortly after the open. What's your analysis just in terms of how big of an overhang you see these tariffs being to the chip stock sector?
Yeah, it's going to have a pretty significant impact. I see lesser an impact from the cost of chips increasing because of the tariffs. Most of the chips are made in Taiwan, as you know. I think the bigger impact is really going to be the impact on end demand, right? If you think about products that are made in Mexico and in China, it's going to be autos, and then out of China, it's going to be PCs, smartphones, and consumer electronics. So as those prices increase, we think there's probably going to be a negative impact to end demand, and ultimately that's going to flow upstream to all the chip companies.
How does that impact then the manufacturing kind of output that we're expecting to see and purchase orders to go into some of those consumer electronics in the near term?
Yeah, there really is not going to be much flexibility there. Like there could be a possibility that some of these companies try to move manufacturing into the U.S. to kind of move the assembly of kind of, all these different components. But in terms of moving chip manufacturing around, there really isn't going to be any sort of flexibility there. Foundries, as you know, there's the CHIPS Act in the U.S. and, these fabs in Arizona and Ohio are under construction, but it's going to take years for them to finish.
John, when you take a look at some of the names under pressure here this morning, NVIDIA, Broadcom, Qualcomm, Applied Materials, Micron, ARM, Intel, the list goes on, that is under pressure here following the open. Who's most at risk?
I think it's going to be the guys who are going to be in the auto industry, so all the analog guys like TI, NXP, onsemi come to mind. You think about all the smartphone names. Those names are going to be impacted, because they sell chips that go into the iPhone. So, for example, Qualcomm, Qorvo, Skyworks is going to be impacted there. And then, if you think about the compute guys, right, smartphone, PCs, NVIDIA, AMD, and Intel are all going to be impacted.
And so with all of this in mind, we've also been thinking about the deregulation tariffs aside that are set to come forth and is set to be prioritized by the administration. Are there M&A opportunities that make sense within this industry?
We do think that M&A is going to continue. We think that the activity is going to pick up moderately, but large-scale M&A is still going to be very challenged, right? When you think about large-scale M&A, you're probably going to have to go through China with SAMR approval. So I don't see much of a pickup in large-scale M&A, but I think small, medium-sized M&A certainly could pick up with some of this deregulation going forward.
John, does this at all, the developments here of the last 24, 48 hours, does this at all impact, I was going through your recent 2025 outlook note, there is a lot of reason to be optimistic about this sector. Does this at all change that longer-term view?
No. When we think about kind of our 25 outlook piece, thematically, the names that we like here are going to be ARM, NVIDIA, and onsemi. We do think that there's going to be tailwinds related to the cyclical recovery in the semiconductor industry. We've been correcting for almost 2 years now. We think, inventories point to a recovery in the second half. And then, secularly, we like NVIDIA. And, obviously, there's some controversies and some unknowns around what the impact of DeepSeek is, but we still think that they're going to be one of the best positioned companies in AI going forward.
John, I just wonder what you make of some of the executives within this industry and within big tech more largely, and how they are kind of annexing themselves to at least have the ear of the president, knowing some of their own growth trajectories, but also their growth ambitions as well. And it sounds like President Trump is going to weigh meeting with, and already has some meetings on the calendar with Jensen Huang as well, one that took place on Friday at least. What would you like to see result from these conversations as they have the ear of the president?
Yeah, I mean, obviously, if you think about NVIDIA, right, they're obviously concerned about, some further repercussions related to China. China's probably under 10% of their revenues these days. It's a lesser impact. But I think if you think about Jensen, his really focus is really just the proliferation of AI. And, I think there's some concerns that, the Trump administration could further restrict exports of chips into China. Right now, NVIDIA is allowed to ship a China-compliant product or SKU called the H20. I think the concern is that they potentially could completely restrict all AI chips into China, right? And that obviously could impact the remaining 10% of NVIDIA's revenues. And I think probably something in between would be a preferred resolution from NVIDIA's perspective.
John, thanks so much for taking the time here with us this morning just after the open. Appreciate it.
Great. Thanks for having me.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. We're taking a closer look at some trending tickers this morning. All stocks that analysts see impacted by the tariffs that President Trump is implementing. We'll talk through these names in 30 seconds each. Let's go. First up, Constellation Brands cut to neutral from overweight. At Piper Sandler, this is due to tariff headwinds. And the analyst, Michael Lavery, says if tariffs last a full fiscal year, we could see a $3 to $3.75 hit to earnings per share for 2026. Lavery says that Constellation will likely hold off on raising prices and instead implement productivity savings. Price hikes could be challenging with competitors Molson Coors and Anheuser-Busch producing in the U.S. with no tariffs.
Plus, transportation names also getting downgrades on tariffs this morning. FedEx, CSX Corp, Norfolk Southern, and GXO Logistics all cut to hold from buy at Loop Capital. The team there writing, quote, that the sector has already been in a freight recession for the last 2 years and that this is going to extend it. They also went on to warn that if this policy lasts more than a few months, all transport companies and Loop's coverage will be hurt by an economic contraction north and south of the border. The firm has eliminated all positive ratings in the transport sector, is now recommending clients stay on the sidelines until the dust settles.
And shares of Ford and General Motors under pressure amid tariff announcements. The U.S. relies heavily on Canada and Mexico for car parts, making this a key sector to watch. Wolf Research says that the average price of a new car may climb by about $3,000 with tariffs. This comes as new vehicle prices rose for a fourth consecutive month in December, sitting near an all-time high, according to Kelley Blue Book.
Well, that does it for Morning Brief this morning, but we are just getting started. Coming up next is Catalyst. Much more analysis on the selling pressure that we're seeing across the board. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we'll break down the market implications of Trump's proposed tariff plans as investors shift into risk-off mode.
Plus, we dive into the consumer impact of levies with analysts downgrading some of the stocks most exposed.
And we'll bring you the outlook for the tech trade as investors await answers on AI spending amid the emergence of China's DeepSeek.
President Trump outlining sweeping tariffs over the weekend, 25% across Canada and Mexico, an additional 10% on China, currently on track to go into effect at midnight. Let's get the view from Washington. We want to bring in what kind of impact this is going to potentially have on the market, on the economy. For that, we want to bring in Henrietta Treyz, Veda Partners Director of Economic Policy. Henrietta, it's great to have you back here on the program. So I think the scale of some of these tariffs certainly taking investors, taking Wall Street, Main Street even, by a bit of a surprise. What do you make of the market's relatively, I think you can call it, muted reaction here this morning, maybe what that signals about what Trump's strategy is going to look like?
Yeah, I think that's a great question for today. Spending all day and all night with clients is effectively what I do. And my understanding and my impression from them is to still have a lot of expectation that these are either going to get materially watered down in the next 20 hours or so, or they're going to be pulled back altogether, especially where Canada and Mexico are concerned. So I think a lot of the market reaction is absolutely muted today versus what it will be should the tariffs go into effect at midnight. There's a lot of expectation that this is not serious right now.
Is part of that expectation due to the fact that the market is anticipating carve-outs for things like energy, for example?
Yeah, I think these are much more wide-ranging than analysts expected. Certainly myself, I anticipated with only 20% odds that we would see universal tariffs. And that's what we have right now with both Canada and Mexico. We have a slightly lower 10% rate on energy, which is, moderately helpful, but that is millions of barrels a day of oil coming in from Canada. So that needs to be taken all the way off the board. And I think a lot of expectation is that huge sectors like the auto industry, which has such integrated supply chains between the United States and Mexico, just to name one, those products cross the border 8 or 9 times before they're even put into the final vehicle. So how many times is that piece tariffed? There's a lot of questions and a lot of carve-outs that I think people are still expecting from here.
Henrietta, what do you think the conversations are like inside the White House here this morning, just given the fact that we know Scott Bessent has been very much has questioned, I think, this type of strategy in the past. It was brought up during his confirmation hearing. He has certainly published papers on this in the past. And given the fact that this seems to be the strategy under President Trump, is that going to act as, and the market's reaction, even though we aren't seeing maybe selling to the worst degree here this morning, is that going to be a check then on Trump going forward?
That's, I think, why the market is so muted today. There's an expectation on the street that Scott Bessent is the one running this show, and he's, got this huge Wall Street backing behind him that's serving as a major voice inside the Trump administration. I disagree with that sentiment. The folks that are dealing with trade in the president's office are much more voluminous than just Scott Bessent, who, by the way, also supports tariffs and has, as a general starting point, this expectation that tariffs will go into effect. So I think that the focus of the street on Scott Bessent is inconsistent with the focus on Capitol Hill and in the White House, where folks like Peter Navarro, Kevin Hassett, Howard Lutnick, Jameson Greer are much more at the forefront. And then let's not forget, President Trump himself is a staunch advocate of tariffs, and he is, unabashedly pro-tariff.
Help me understand the totality of policy from the Trump administration, how business-friendly or unfriendly it might be. According to some notes this morning, the market kind of holding on to this idea of an 11th-hour deal. Is that such good news for the market if that stops tax cuts, for example, because there's the idea that tariffs will pay for those tax cuts?
Yeah, the pay for component is really critical here. One of the things we're watching closely is the House Budget Committee, which was supposed to convene this week to begin work on that tax bill, paving the road for that tax bill to get written. My expectation is that they're delayed at least a week. And quite frankly, I have very low optimism that they can get their one big bill through. I think a tax bill is not going to happen until December of 2025. And I think what's different that the street needs to incorporate when we say that the first round of tariffs weren't inflationary, first of all, that was on $350 billion worth of goods from China. This one is $1.4 trillion worth of goods. And we do not have the added stimulus of a 14% percentage point corporate rate cut that was just enacted a couple of months before those 2018 tariffs went into effect. So it's a very different scenario, very different environment for these tariffs to be going into effect, which will start as early as 12 o'clock tonight. And the tax extension is A, not stimulative, and B, not going to pass until December.
How much money if these tariffs, let's just play it that way, if these tariffs do go into effect at midnight, how much revenue will be raised from this?
It depends on a lot of the carve-outs that, again, we're expecting, but what they're factoring in is about $1 trillion in revenue. My expectation right now from a $74 billion run rate in terms of collections is maybe they get that up to 100, and over 10 years you can get to $1 trillion, but all those tariffs would need to stay in effect and probably continue to escalate as supply chains move, as retaliation hits GDP, things like that. So I think $700 billion is probably the max that they should assume. And that is a tax on, obviously, everybody, U.S. consumers.
Given that explanation, Henrietta, do these tariffs potentially change the course of action from here on out for the Federal Reserve?
That's the big question. If the tariffs are inflationary, are we going to be able to see Fed cuts? Are there going to have to be Fed hikes? If we're also simultaneously planning to lay off huge portions of the federal government via DOGE and, furloughing federal employees, that's going to raise unemployment. Those puts and takes are really critical. I am highly skeptical that the Fed's going to be able to cut rates this year if we have inflationary tariffs.
I want to talk about congressional pushback before I let you go. On X, we saw Senator Chuck Grassley asking for an exception for farmers, and we're going to throw up that post that he made this morning here on our screen. He's pleading with President Trump to exempt a fertilizer from the tariff because of the impact it could have on farmers that are his constituents. How successful do you think members of Congress can be at getting these exemptions?
I think those exemptions should be forthcoming. And the question really then becomes, does Canada see that pain and decide to keep the pain alive? Really, it's the retaliation that we have to be worried about. The short version is the senators do not have the power to strip the president of his authority to impose these tariffs. They do technically have the power. They don't have the votes, is the way I should say it. So they simultaneously don't have the votes to support the tariffs and calculate that revenue in their tax bill, but they also don't have enough votes to go against the president and strip this power away from him the way that they could otherwise do if they wanted to. They could. So the expectation that I have is that you're not going to see necessarily a potash carve out. I think we're, at this point, lucky to see energy carved out and those 10% tariff rates brought down to zero, which would be huge for states like Maine. 95% of their heating oil comes from Canada. You're going to see winners and losers. And I think the way the Trump administration has responded to the farmers' retaliation in the past is to provide bailouts to the farmers. We've passed 4 so far, totaling almost $50 billion for the farmers. So I would expect more of that in an upcoming government funding bill. Or in a debt ceiling negotiation, things along those lines. There will be more federal spending along those lines to again, keep pressure on the Fed.
All right, Henrietta, we've got to leave it there. Thank you so much for joining us. Appreciate it.
Thanks for having me.
Elon Musk's Department of Government Efficiency, or DOGE, is taking aim at U.S. aid. Musk saying in an audio conversation on X that the department is, quote, in the process of shutting down U.S. aid, claiming that it's, quote, a criminal organization. President Trump also telling reporters of plans to remove members of the agency's staff.
USAID, run by radical lunatics, and we're getting them out, and then we'll make a decision.
Workers at the U.S. Agency for International Development, which provides humanitarian assistance overseas, were reportedly told not to come into the office today. The USAID official governmental website went down on Saturday, February 1st. This comes after 2 USAID workers were placed on leave for reportedly not allowing DOGE access to personnel files, including classified material. DOGE member Katie Miller claiming on X, quote, no classified material was accessed without the proper clearances. This comes as Musk also says DOGE is suspending Treasury payments to some U.S. government contractors, including claiming without evidence that one organization, formerly known as Lutheran Immigration and Refugee Service, is receiving illegal payments. The CEO of that organization saying, quote, it condemns in the strongest possible terms the false accusations being lodged against our humanitarian work.
Coming up, we'll be taking a look at a slew of trending tickers here at Yahoo Finance, including Disney. It's set to report earnings this week amid questions about the impact that tariffs could potentially have on the media sector. We're going to have that for you when we come back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with the Yahoo Finance's trending tickers page. First up, let's take a look at some consumer stocks that are taking a hit this morning from President Trump's tariff plans. Constellation Brands, Diageo, and Chipotle among the names moving to the downside this morning after Trump announced sweeping tariffs on the United States' biggest trading partners, including Mexico and Canada, as well as China. Now, these tariffs could lead to price increases potentially for consumers and in turn weigh on demand, and that is really the big focus. But ultimately, this is going to do here to the bottom lines of some of these companies up on the screen right now. Constellation Brands actually getting a downgrade here this morning on the heels of that. We're seeing that stock now off just about 3.5%. It had hit the lowest level that we had seen since October 2020 when it was off 8% earlier this morning at the lows here of the session following that downgrade. But again, Maddie, when you take a look across the sector, and these are just three names that we're pulling out here just to show you the broader impact that this could have here on these businesses going forward. But again, lots of questions about what's going to do to input costs here when you talk about materials, when you talk about goods here for these companies to which they are selling. And then also the big question is the ability, I think, at this point to pass down some of those price increases to consumers and whether or not, and I think very much this argument is being made, it's going to be a bit trickier this time around.
Right. Getting that cost passed on to consumers is a lot harder in an environment where consumers have already been buckling under the weight of inflation. And we are seeing those credit card credit expenditures increasing already. I do want to pull up a chart, though, that we had pulled this morning showing that the amount of imports coming from Mexico here and just the degree to which different categories are imported from Mexico. You can see here about 13% of Mexican imports coming from beef, tequila is up there, tomatoes and peppers and avocados. All of those potential food and beverage categories potentially going to be impacted by these tariffs here, and obviously that can have a hit on a company like Chipotle, for example. Obviously, some of the other companies we mentioned, like Constellation Brands, also potentially impacted here when you think about just how much of these products that we are getting in from Mexico. And this, in part, is why we are also hearing members of Congress today talking about wanting some of these exemptions from these tariffs, carve-outs for specific products that they think that their constituents are not necessarily going to be happy about moving forward.
Yeah, certainly. You're also seeing names like Cava fall as well. Starbucks is one of the names that we were tracking earlier this morning when you talk about the impact that these tariffs could have. But you're exactly right. The question comes down to some of these carve-outs. We're talking Henrietta Trays. And I think what is making it so tough here for Wall Street at this juncture is just even the quick escalation that we have seen in the tariffs. Many people did not even anticipate that here we are Monday morning discussing the fact that these are going to be implemented tonight at midnight. So I think that very much has so many people on the street, and even Main Street, just very much sitting on the sidelines, really questioning how this could potentially play out, when so many were very confident that he wouldn't follow through with some of these threats just last week.
And it seems like the market is somewhat more confident this morning that these could just be threats. We are trading on light volume, but still under pressure. So, of course, we'll continue to monitor any of those updates as we get them. Next up, we want to focus on Chinese stocks, moving mostly lower on the back of President Trump's plan to impose an additional 10% tariffs on goods from China. President Trump also halting a trade exemption that allowed exporters to ship packages worth less than $800 into the U.S. duty-free. Without that de minimis exemption, products from China's online retailers will face those tariffs, and that could push up those prices. But it is interesting because there is also an argument to be made that some of these tech names in China are a safe haven. We heard Jay Pulaski talking about that and issuing a note to that end this morning, saying that the China tech names are trading at a 50% discount to U.S. tech. And given what we've seen coming out of DeepSeek, there is potentially this idea that U.S. tech has been exposed as not necessarily having as much value as some of these Chinese tech names. So maybe there is a haven bid there, but we're clearly not seeing that in the trade today.
We're not seeing that in the trade, and I think this also just very much illustrates, going back to kind of the argument that we've been making, some of the jitters playing out right now in the market, the uncertainty, very much a little second guessing before jumping in on some of these names. We are off the lows of the session with some of these, especially when you take a look at BABA and some of the movement that we are seeing there. They were under a bit more pressure here earlier this morning when they first started grabbing our attention. But lots of questions just about the carve-outs, lots of questions about maybe actually the Trump administration is going to take it even a step further when it comes to the escalating geopolitical risk here, specifically between the U.S. and China. And I think when you take a look at that argument versus what we're seeing play out with Canada and Mexico, it's two very different sides, right? Just in terms of the history of some of that back and forth, the backlash, the retaliation, and what that could look like, and what ultimately is going to force maybe President Trump, with the Trump administration's hands, to potentially back down. But again, so much of that uncertainty, I think, is why we aren't trading too far from the flat line on so many of these U.S. Chinese listed stocks, at least for now.
A lot of questions remaining here.
Certainly are. All right, well, how could Trump's tariff impact the entertainment business? That's just another question that we're trying to break down here this morning. Alexandra Canal's all over that for us. Ali, what should we know?
Yeah, well, a lot of TV shows, a lot of movies, they actually film in Canada, and there's some pretty attractive credits there, tax credits that a lot of these studios get by filming in that country. And then since then, we've actually built up a pretty consistent labor force over there. So if this trade war escalates, there's a bit of a concern that that's going to weigh on production budgets. You could potentially have a removal of some of those attractive tax credits. There are some experts that still say that the relationship between China and the U.S. is strong enough to withstand any of these levies that Trump is threatening to impose come midnight. But still, I mean, Canada is basically the northern Hollywood, is what they've been calling it. So if we see a trade war continue to escalate, if we see any type of retaliation, every single industry, whether you talk about the obvious ones or maybe not so obvious like Hollywood, is watching that very closely.
It's a great reminder of just the impact it could have across the board on price increases. But speaking about Disney specifically, we do want to talk about earnings while you're here. Obviously, mixed picture heading into these results here. Great performance at the box office, but I know Disney Plus subscribers are still a question mark.
Yeah, and look, on the streaming side of the business, operating profit is expected to fall by $38 million in the quarter. So this goes to show just some of the bumpiness when we think about streaming profitability. That is a significant year-over-year improvement. But remember, last quarter, we saw profits of over $300 million. So again, that bumpiness. I will say that we should see continued strength and momentum as the year progresses, and it will continue to offset some of the declines that we're seeing on the linear side. There's also been a lot of uncertainty with the park side of the business. And to that point, Disney did say that Hurricanes Helene and Milton, they're going to register a hit of about $130 million in the quarter, while those Disney Cruise pre-launches will tack on an additional $90 million. Beyond the first quarter, though, Disney did say that operating income at the parks will grow between 6 and 8% for the full year. So improvement is expected, especially towards the back half of the year. So, the solid guidance that Disney provided last quarter for 2025 and 2026, that's been priced into the stock. We're seeing shares up about 15% on a year-over-year basis. Citi coming out, resuming coverage of Disney, saying that they see an attractive risk-reward profile moving through the next year. Of course, there's always those overarching questions that Bob Iger will face on the call when we think about the Fubo, Hulu Plus Live TV integration, what's going on with the sports side of the business, ESPN over the top, the succession question that still looms in the background. We're going to hear about who the next CEO of Disney will be in the beginning of 2026, but I'm sure throughout the course of this year, a lot of question marks when it comes to that.
There's certainly a lot to unpack. Now you have me second guessing actually what my question will be, but I'll stick with what I was going to ask, and that was the Fubo TV, Hulu Live TV, the acquisition there. How material of an impact is that expected to have here for Disney going forward?
Well, that's going to be a big question on the call, because this is the first time that we're going to hear from management when it comes to what the outlook will be when it comes to sports, when it comes to operating income, operating margins. I mean, yes, how significant is this going to be? Is it going to weigh on some of the spending? How is that going to trickle through into earnings? So that's a big thing that people want answers to on the call, or at least a bit more clarity when it comes to Disney's thinking about this. Was it a pure sports play? How did that relate to what went down with venue sports? I mean, obviously we saw that disappear at this point. Could that be resurrected? Who knows? So yes, for this earnings report in particular, I think it's going to be a lot more of a call-focused earnings when it comes to the outlook for some of these big questions.
And of course, the successor too.
Yeah,
right.
Always.
What that looks like.
Absolutely. Well, Allie, I know you'll bring us the updates on that as we get them.
Yes.
Thank you so much for joining us. Appreciate it always. We'll have all of your markets action ahead right here on Yahoo Finance. So stick around for more. You're watching Catalyst. President Donald Trump's sweeping tariff plans are expected to impact consumers and businesses. But what kind of fallout could this have on the investing space more broadly? Here to discuss, we've got Sarah Kuntz. She's the managing director at Clio Capital, which is invested in companies like Hill House Home, Cameo, and Gemini. Sarah, it's great to speak with you. Thanks for coming on. So it's interesting because it feels like the lesson from the past 4 years has been don't fight the idea of a resilient consumer. How do you weigh that against the risk to consumer names and consumer spending more broadly that is presented by tariffs?
I think that only some consumers are resilient, right? So there is certainly a large swath of the population that has been doing very well over the past few years, has really been reaping the gains of a strong economy and a strong stock market. And then there are people who haven't, right? And so when you look at the companies that are going to be impacted, I think particularly in the face of tariffs, it's companies that import a lot from those partners. And so if you're an Amazon out of the Mag 7, it's probably going to hurt you a lot more than it hurts a Meta, although even that might have some impact if it impacts ad spend. And so I think that the question is how many of these consumers are doing well, especially if we start to see factory slowdowns and layoffs and some of the other things that have been predicted to happen in places like automakers relatively quickly.
Sarah, do you consider, I guess at what point do you consider a shift then to your investment strategy when it comes to some of these consumer-facing names?
So I invest in consumer-facing names, and a lot of them who have already been looking at, like most companies, at buying more inventory in advance from countries that could be impacted, which sounds like the EU might be next. And so, in names like Hill House, there's certainly those kinds of companies have very smart CEOs who have been listening to the news over the past handful of months when tariffs have been floated and have been responding accordingly. So I don't think that with venture, we are talking about 10, 15-year timelines. There's a huge shift right away in strategy. If you believe in something, you believe in it. But I do think that smart, good, diligent CEOs who've been, sort of looking at this and knew that it was coming are going to be rewarded much more than those who sort of just were riding on vibes and hoping it would all work out.
Yeah, it's interesting you talk about the companies working to preempt this. I know Amazon had added that section to the site earlier in the summer to compete with the likes of Temu. And that brings me to another topic I wanted to get to with you, the potential ending of that de minimis exception here, which does let go of tariffs for packages worth less than $800. Who stands to benefit from that? Does that hurt fast fashion and then lead to a potential uptick for some of those more luxury names in the space?
I don't think that most people are trading from Temu or Shein to Loro Piana, sure. Right? You have to be cognizant of where the consumer sits. But the reality is that fast fashion is a problem on a lot of levels, and it's certainly not just the Chinese companies who contribute to it. We have so much stuff going into landfills, we don't know what to do with it. We're just dumping it on entire continents. And so, if there's a slowdown in that, are tariffs the best way to do that? Probably not. But, you saw the U.S. exchanges kind of decline to list Shein. And I think that that's part of a larger trend that needs to be happening, which is you say, is this company sustainable? And what is this doing to the market and to the world? And so I think that the winners are going to be those kinds of in-between retailers who are making things that are durable, that last, that are higher quality. Maybe they're domestic, maybe they're not. But I do think that a lot of those sort of mid-price fashion lines have really been left behind because there's either a flight to quality at the highest end or a flight to quantity at the lowest end.
Sarah, beyond tariff policy, when it comes to some of the other policies we've heard from the Trump administration, whether or not that be tax cuts, whether it be a lighter hand when it comes to regulation, how do you see that impacting VC capital flows? And more particularly, I guess, how do you see that shaping some of the opportunities that you're now identifying here over the next 4 years?
Yeah, I mean, I think that you certainly have to look. I've been invested in things like crypto since 2013 personally. And so you look at some of those opportunities where there was a ton of regulatory uncertainty, and now hopefully there will be more clarity. And certainly, they've been doing well. They're likely to continue to do well in a more sort of clear regulatory environment. That is good. I think that you look at some of these opportunities on a sort of sector by sector sector basis. AI, I think, is going to continue to be strong at the startup side, although maybe different kinds of companies and less of the sort of chatbots that we saw dominate last year, and more things that actually drive revenue productivity. And that is sort of less to do with the current administration and more to do with just where this sort of puck is going in terms of what the street wants to see out of artificial intelligence, what they want to see out of these CapEx expenditures. And so I think that there are bright spots, particularly on the internet, where we're not as beholden in general to tariffs.
What trade then does that potentially initiate? And I ask in the context of something you put in your notes too, this question of so what when it comes to AI CapEx and DeepSeek kind of lifting the curtain and saying maybe this amount of CapEx isn't necessarily justified. If that is true, then what should investors be thinking about when it comes to AI investing moving forward?
I think they have to look at where is it going to actually drive revenue. They have to look at, are you getting better ad buys because you're using AI to target? Are you getting, or on the flip side, is so much AI slop filling people's social media feeds that they're spending less time on the platforms? And then, that's not good for advertising. So I think that a lot of it is coming away from just AI exists, throw money at it, and saying, how are you using this to drive value? And there certainly are areas where you will see a lot of that. I think in enterprise, there have been a number of legal tech startups that are using AI in ways that I think that generally are going to make sense. So there will be bright spots there, but I think that sort of general idea of more AI for the sake of AI is a good thing feels a little bit 2024 at this point.
All right, Sarah Coons, thanks so much for taking the time to join us here this morning. I want to bring you some breaking news crossing the wires right now. Mexico's president saying that tariffs have been delayed or will be delayed for a month. Mexico and U.S. to work on security and trade. Mexico is also expected to strengthen its northern border with the National Guard. And Mexico saying that U.S. tariffs, again, will be delayed by 1 month. So we're seeing, if we could pull up the market's reaction here to these headlines in real time and the impact that it's having on U.S. equity markets here this morning. Again, we have been under a significant amount of pressure earlier, or some pressure earlier. We are well off the lows here of the session. You got the Dow off just about 0.5%, the S&P off just less than 1%. The NASDAQ also still in the red, off more than 1% right now. We'll be right back. Mexico's president's delivering remarks now on retaliatory tariffs that she ordered on Mexican goods following Trump's sweeping tariffs announced over the weekend. Those tariffs will now be delayed by 1 month. The president also announcing that the U.S. and Mexico will work on security and trade. Mexico plans to strengthen its northern border with the National Guard. A little bit more from the president here of Mexico, saying that Mexico plans to deploy 10,000 National Guard troops to help secure the border. They're going to continue to work with the U.S. on, quote, security and business. We're seeing, more broadly speaking, the market's reaction to this news well off the lows here of the morning. You now have the Dow off just about 0.5%. The S&P also pairing its earlier losses. You can now see it off about 0.9%. And Maddie, once you dig a little bit deeper, there's been lots of focus on the currency markets here this morning. We're also seeing some movement in the peso and the Canadian dollar as well.
That's exactly right. Following the announcement from the president of Mexico here, the peso retracing all lost ground since before that tariff news broke over the weekend here. So if we can take a look at the peso, you'll see that recovery. Also a question as to whether or not the Canadian loonie is going to continue its recovery. You can see a little bit of that playing out here, but the market perhaps still anticipating what that phone call that's expected to occur between Trump and Trudeau later today is going to look like, and whether there's going to be any potential delay to Canadian tariffs here that could also lead to a little bit of a relief rally in the loonie. Having said that, I think also what's important is the impact we're seeing on stocks. Canadian stocks already recovering off the back of this announcement from Mexico today. And also we're seeing European stocks pairing their losses, and of course U.S. equities continuing to pair those losses as well following this announcement that these tariffs are not potentially going to be in effect here, at least for another month.
All right, well, certainly that impact we're seeing play out here across the market. President Trump's sweeping tariff announcement initially that included Mexico. We're now getting those tariffs here postponed for a month, but tariffs that are expected to be enacted still on Canada and China. What's the potential impact here for the American manufacturing sector? For that, we want to bring in Tim Fiore. He's ISM Manufacturing Business Survey Committee Chair. And Tim, let's start there, and then we'll get into the data that was released this morning. What are the implications here for the manufacturing sector when it comes to these tariff threats?
Oh, this is really good that they've delayed it. Very good. Really good news. I mean, this is breaking real time. So this is not my first interview this morning. My prior interview was a lot different than this one. We're not big supporters of tariffs, primarily because it clogs up the supply chain and it adds costs and it takes money out of consumers' pockets and it puts it somewhere else. So, and tariffing your two closest trading partners, Canada and Mexico, is a really big deal. Really confusing. The other thing that happened with the tariffs is that they're not allowing duty drawback. So if 50% of the value of a car coming in from Canada has U.S. product on it, right now the intention is to tariff that 50% too. So, and that's very unusual. I'm not even sure that that's lawful, and it doesn't make any sense. So what you're really doing is you're incentivizing Canadian manufacturers, which are U.S. manufacturers too, to not buy U.S. products. So it doesn't make a ton of sense. So and if we had duty drawback, although it's an administrative pain, there's a lot of bureaucracy that goes with that, and it's slow in getting your money back, but it does resolve issues. So because generally you only want to tariff stuff value add. You want to tariff the value add that occurs in another country, not your own stuff that you ship there and it comes back. And we have that problem in Mexico and in Canada with stuff crossing the border multiple times, mainly Canada, but also to some extent in Mexico. And remember, I mean, a lot of what's been going on here in Mexico over the last couple of years is to try to get away from tariffs that are happening in China.
Right.
So, and then to take that after you've made an investment, put a factory in or hired a supplier to make stuff in Mexico, and now you're going to tariff it, it defeats the purpose. So good news, just heard, not sure how official it is, but it sounds like they've decided to delay for a month the tariff imposition, at least in Mexico. And I think that's a very positive thing. Let's get on with the discussions with China, which are, to me, are the biggest discussions.
Well, Tim, let's talk about what those discussions might look like then, because there's this big question mark about whether or not this is a negotiation tactic from the Trump administration or if this is real. When it comes to the China question, do you view it as a negotiation with China, or are we really going to see some pain here?
I think in the normal world, it's not a negotiating tactic with China. This has been going on now for 6 years since the last Trump administration, and he had the courage to stand up and say, hey, this isn't fair. And it hasn't been fair. And I mean, it's been fair to the American consumer, not the American worker. And it hasn't been fair to American businesses because when you're making stuff over there, many times you lose your IP. as you guys know. So, I think that the real issue is China, and China's doing a lot of things here to protect themselves. Some of the things they've done is it looks like they may have done some pre-buy to avoid their own counter tariffs in December and January this year. You'll see that with our import number being up and our new export order number improving. So, and most of that came from China, either from stimulus or from people trying to get product in before there's a counter tariff on it. So, but I think the USMCA issue, work that out. There are two partners. We're integrated in a lot of areas, electronics, automotive, obviously, the energy markets, the steel markets, we're integrated with them. So, let's not destroy that, because that's a competitive advantage for North America, including the American worker.
Tim, what are you hearing, just more broadly speaking, from these industry executives, just about their outlook right now under the Trump administration? Here we are a few weeks in. Some of these policies clearly has been a little bit more aggressive in his action and his rhetoric here when it comes to trade. How are they then factoring that into their outlook, to their strategy then over the next several months?
So, we knew that the Trump administration would be disruptive, and we knew there would be a lot of feints. I don't think there's any real surprise here. The business community is positive about this administration. They see the reduction of regulations, the more business-friendly environment, positivity here on the Tax Cut and Jobs Act staying in place after 2025. That's all positive. This other stuff is very confusing. I don't think you probably, if you talk to 10 CEOs, Fortune 100 companies, they'd all say that they are not supportive of tariffs. And then the question becomes, what is this for? Is this for budget improvement, to be able to extend the Tax Cut Act, to be able to fund stuff at the border? Or is this really to stop migrants and illegal drugs from coming into the border? It's not clear. And that's one of the issues with the Trump administration. Sometimes it's not always what you hear. But I would say, President, what this was they were not really prepared to deploy these tariffs. Like I said, no duty drawback sends a huge message. And you saw at the last minute, I think on Friday, they reduced the tariff on Canadian oil to 10%. Now that Canadian oil it sells a lot cheaper in the U.S. than West Texas Intermediate. So what they really did is they just brought the price of that oil up to equal West Texas Intermediate. And then we do get a lot of petrol products from Mexico too. So I think this whole thing around what's good for all of us and what's good for America, and I think we got a month now to figure that out. I think Trump has clearly said, I'm going to do it. He said he's doing it, and now he's going to pause it. So we're making progress, I think.
All right, thank you so much for joining us, Tim. Really appreciate it. Also want to mention Trump here confirming the delay of Mexican tariffs for 1 month. Again, the president confirming that delay of tariffs against Mexico, also saying that he will be having talks with Mexico headed by Marco Rubio. Also, Howard Lutnick, of course, is going to be involved in those conversations here, and we will continue to monitor any of those headlines as we do get them from the president, again, confirming that 1 month pause in tariffs against Mexico. While January was a strong month for stocks, history says investors should brace for a rocky February. Here with the details, markets editor and host of Stocks in Translation, Jared Blakely. Hey, Jared.
Thank you, Maddie. We're going to take a look at the entire year. Since January was positive, we know that means that the entire year tends to close green, but exactly what path will it take? We're going to take a look at February in particular in just a minute here. Excuse me, but I want to show you what's happened. I have two market maps right here. The first is a median since 1928, when we have the same day of the week. So all the Monday, February 3rds get counted in this white line that's here. And then we have the average, the median since 1990. That's in green. The median since 1990 is pretty steady there, but I want to show you what happens with February. We get kind of a rise into the middle of the month and then a decline here. And we can see in blue, this is what's already happened this year. And with today's decline, we're actually looking down a little bit. So I want to show you, before I get to the February map, what it looks like in the VIX. I use the VIX fear gauge map, and this goes back all the way to 1990, and it's just an average. This is kind of a confirming indicator for what I'm expecting stocks to do. So as a reminder, when the VIX goes up, that usually spells trouble for stocks, means they're going down. What we see here is a spike into mid-February, then a decline, then another spike into March, which just indicates to me that we have some potential headwinds, some potential bearish catalysts on the horizon here, and we might already be seeing some of them with these tariffs. Now, for February itself, this comes via Ryan Dietrich over at Carson Group, and we can see this is kind of what I was talking about in that prior chart where we have this rise in early February, a little bit of a decline here, then we peak mid-month right around Valentine's Day, and then it's a slow, steady decline into the end of the year. And I should mention that these are just tailwinds or headwinds. This isn't what the market has to do. It's just what it has done historically. And we've seen these maps kind of provide a good map over the last few years. So take this with a grain of salt. And then I'm going to finish on what has happened since the inauguration, since that's a key time period that I'm looking at. And this is the sector action as we're seeing it. Healthcare, communication services, which has Meta and Alphabet, and then consumer staples, which is defensive, and then financials. Those are all strongly in the green. We can see financials up about 1.5%. Healthcare has come, it's been a sleeper, come from behind story. That's up 5%. But what has not worked, energy and tech, those are the two big losers since the inauguration, and that's probably where we're going to see continuing the greatest volatility. But we do have a little bit of a defensive setup that we're looking at since the inauguration. So again, healthcare and staples, those are kind of defensive. Those have done well, along with communication services, and then those financials may be on that deregulation tip that we've been talking about so much. Back to you guys.
All right, Jared, thanks so much for breaking that down. We're going to leave it there. Much more on your market action ahead. Again, well off the lows of the session following developments that it looks like the Trump administration is going to delay tariffs imposed on Mexico by at least a month. Some of the headlines that we're monitoring coming out of the White House and D.C. right now. Again, you're looking at the markets off the lows of this session. The Dow actually now up just about 0.3%, so even more of a bounce back here as we do further digest these headlines. The Nasdaq, though, still down just about 1%. We'll be right back. President Trump confirming moments ago on Truth Social that he is delaying tariffs against Mexico here when it comes to what exactly can be anticipated here. He's saying that over the next month, he's delaying it by a month here, saying that over the next month, we will have negotiations headed by the Secretary of State Marco Rubio, also Scott Bessent, head of Treasury, and Secretary of Commerce Howard Lutnick, and high-level representatives there of Mexico. He said he looks forward to continuing the conversation here with Mexico's president as they do attempt to, quote, achieve a deal between the two countries. You're looking at the market's reaction to this, bouncing off the lows of the session, a bit of a give back here from what we've been seeing here. You're looking at the Dow now off just about 0.3%, the NASDAQ still down about 1%. Yahoo Finance's Ben Worschel, our DC correspondent, joining us now with the latest. Ben.
Yeah. Hey, Shauna. So yeah, as you just mentioned, sort of the big news here on the Mexico side of this, but some still open questions. This has been kind of a trend throughout these talks back and forth, where Trump sort of somewhat counterintuitively is harder on Canada than he is on Mexico. He also updated this morning on the Canadian talks. He talked to Prime Minister Justin Trudeau this morning. He sounded much less optimistic coming out of that, raising new issues about Canadian banking and things like that, and then said that he will talk to Canada again at 3 p.m. But like you mentioned, the Mexico one is the mover right now that he's going to delay these by a month. The Mexican president has also confirmed that as they continue these high-level talks on fentanyl and illegal migration are the key issues for him right now.
And Ben, I was just talking with Shauna about this in the break, kind of the differences between Canada and Mexico here when it comes to this fentanyl argument coming from the White House and immigration. Talk to me about how that positions Trudeau as we potentially get that phone call between Trump and Trudeau heading into this afternoon.
Yeah, I think Trudeau is in a really tough position here right now because the migration and fentanyl arguments the data just doesn't bear out that Canada is a big issue here. They are on the rise. There are reports, and the White House has cited these, that there is increased illegal migration and increased drugs passing through the border, but it's still just a tiny fraction of Mexico. And China is also a huge player in this, in that they sort of tend to do the precursors. It goes to labs in Mexico and comes into the U.S. The trade through Canada is really minimal. So it's led to a lot of questions about exactly what Canada can do here. And so far, they haven't been able to figure this out. They've talked about increased border activity to decrease this. But the bottom line here is that if you're really looking to tackle the issue of drugs and fentanyl and illegal migration, the Mexican border is the key one. And Canada, by all accounts, is kind of a side player on this, although it is growing slightly.
Ben, where does that leave the conversation with China?
The China, we still don't know yet. So China is due for 10% tariffs. Also tonight at midnight at 12:01. We don't have any updates on that from the White House right now, and those are ongoing. What China has promised is that they're going to retaliate through the World Trade Organization. They're going to do a lawsuit that way. So it's unclear what that would be or how much conversations were there. What Trump has said, and he said this last night into today, is that he's talking today with Canada and Mexico. We don't even know exactly what sort of conversations are like with China at this point. He seems to be focused on our immediate neighbors for the moment.
He did over the weekend talk about, President Trump spoke specifically about the European Union. Let's take a listen to what he had to say.
European Union is really out of line. UK is out of line, but I'm sure I think that one can be worked out. But the European Union it's an atrocity, what they've done. With the European Union, it's $350 billion deficit.
Ben, if we're already saying that we're awaiting clarity on China tariffs, that the focus is Mexico and Canada, when could we anticipate clarity on any tariffs related to the EU?
That's a good question. Trump has outlined February 18th as one of the deadlines he's watching, so he's sort of signaling it's going to be very soon. His stance with the EU is that there will absolutely, is his word, be new tariffs coming, but has been kind of vague on the timeline. I'd also add that in recent days it's just a wide array of threats. EU has been the most intense, as you noted, but he's also talked about new semiconductor tariffs, copper, steel, and aluminum tariffs, issues like that on specific sectors that he's planning to roll out either in the weeks or months ahead. So he promises they're coming. Exactly how it does and exactly how much this Mexico delay changes that is we're still sorting out.
All right, Ben, thanks so much for breaking down the latest headlines that we're getting out of Washington. Keep it right here on Yahoo Finance. Wealth coming up next.
It's time for Yahoo Finance's Market Minute. Stocks are paring back earlier losses after President Trump confirmed that tariffs on Mexico will be delayed by 1 month as the countries work together on security and trade. Shares of automakers Ford, GM, and Stellantis are all still lower, though, as tariffs on Canada could mean higher costs and supply disruptions. Millions of cars sold in the U.S. are assembled in Canada with parts coming from China. And chip makers with large exposure in China are also trading lower. Tariff news, along with reports of further curbs on Chinese chip exports weighing on Nvidia, Broadcom, and Applied Materials. Plus, Constellation Brands getting a downgrade from Piper Sandler, the analyst citing tariffs as a headwind for the company, saying it could see a $3 to $3.75 hit to its full-year earnings for 2026. And that's your Yahoo Finance Market Minute.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. And on today's show, Trump's tariffs will help you understand what tariffs are and how they're used and what they could mean for your wallet and the impact there. And tech on deck. We've got more tech earnings this week from the likes of Alphabet, Snap, AMD, and Palantir. We'll discuss what investors should be looking for. Plus, we're less than a week out from the 59th Super Bowl. We'll discuss all things ticket prices and financing fandom with resale app Game Time's CEO. All that and much more coming up during this hour. But first, President Trump is planning to impose 25% tariffs on imports from Canada and Mexico and a 10% additional import tariff on China. Now, these were meant to take effect Tuesday, but Trump now confirms the Mexico tariffs will be delayed for a month amid ongoing negotiations. Trump is expected to speak with Canadian Prime Minister Justin Trudeau later today. But let's put this into context and break down what tariffs are, what they do, and how they might impact your wallet. Tariffs are taxes imposed by one country on goods imported from others. In the simplest terms, they're used to collect income, reduce competition for domestically made products, and place an economic burden on foreign exporters. For that reason, they're often used as bargaining chips. Former President Biden actually used a few selective tariffs during his presidency against China to support American manufacturing of semiconductors and solar panels. But the key word there is selective, only on certain products. The tariffs that President Trump is implementing and are in negotiations on are sweeping, and the implications are much broader. Mexico, China, and Canada are the U.S.'s largest trading partners, so with tariffs, a slew of goods like cars and electronics could get more expensive, and so could raw materials. So when the costs go up for aluminum, oil, and steel, even if something is made in the U.S., manufacturers will pass the cost on to American buyers. Could the U.S. get their goods elsewhere? That's the big question. Eventually, maybe. But building factories and reorganizing global supply chains, that takes time. In the meantime, Americans may end up paying much more for some everyday things. And we've got team coverage of how exactly these tariffs could hit your wallet. Yahoo Finance senior reporters Brooke DePalma and Inez Ferre are here. Brooke, you're here on set with me. Let's start with you. What are you tracking in terms of some of the impact that could be anticipated here?
Yeah, good morning, Brad. This could have major implications for just how much spending power U.S. households spend. Experts estimate that this could cause an increase in tax, so to say, for U.S. households of upwards of more than $800 to up to more than $1,200 this year alone, as these potential tariffs could go into effect. Now, let's take a look at the top U.S. agriculture imports from Mexico and Canada. They're our top partners for the U.S., and they account for upwards of more than $40 billion worth of agriculture products shipped here to the U.S. Mexico, mainly for avocados, beer, liquor, as well as tomatoes and peppers. Canada, including things like grains and potatoes. And as we noted earlier, talks in Mexico are still ongoing. But should these take into effect, consumers could see prices increase in the following weeks. And that's on a commodity items, given the turn of inventory happens quickly with these goods like avocados, tomatoes, and peppers. that could mean an increase in price in just weeks to follow those taking place.
And in addition to grocery prices, how is this going to impact some of the other goods, consumer goods that are out there?
Yeah, many footwear and apparel companies, they have large production manufacturers still in China, and that could mean major implications for the cost of goods like footwear, like glasses, and apparel. So let's take a closer look at some companies that still have major footprints in China, as well as Mexico and Canada. Companies include Warby Parker. They have 20% of their goods sourced from China. Yeti, 40%. Crocs, roughly 28% from China, as well as Skechers. If you take a look at this, these companies largely have diversified some of their footprint from China, but in order to deliver innovation, in order to deliver comfort, Skechers CFO telling me last September that they want to keep this low-cost production, and they're able to do that with these facilities. But in order to keep that innovation, in order to keep that comfort, that could mean a higher price for the consumer in the coming months, once they could potentially go into effect, these tariffs.
All right, we're going to be tracking it closely. We know you will too, Brooke. Thanks so much. Staying on the same thread here, oil prices are near the lows of today's session after President Trump announced proposed tariffs against Mexico will be delayed by a month amid ongoing negotiations. But if implemented, President Trump's proposed tariffs against Canada and Mexico could have big consequences for Americans at the gas pump. Ines Ferre joins us now with more. Hey, Ines.
Hey, Brad. Yeah, and gasoline futures jumped on the tariff announcement over the weekend. That's because the U.S. imports about 4 million barrels of heavy crude per day from Canada, almost another 500,000 from Mexico. But it's really the Canadian oil supply which could spur prices higher at the pump. And by how much? Andy Lippo of Lippo Oil Associates says by about 15 cents per gallon on both gasoline and also diesel. Patrick DeHaan of Gas Buddy predicts anywhere between 5 cents to 20 cents per gallon. A lot of this, though, depends on how much oil Canada can divert from the U.S. to other markets, because Canada has limited capacity for getting its oil to other markets besides the U.S., which brings us to the point Goldman Sachs analysts made in a note last night. Longer term, they see Canada's oil producers as taking the brunt of these tariffs, because if they don't have other markets to send them to, then they'll have to reduce their prices. But the analysts say it will be a combination of Canadian producers and the U.S. consumer that will be paying more. Now, refineries have such razor-thin margins that those have been falling, and they're not going to be able to absorb a 10% tariff on their imports. Now, which are the states which will likely be impacted? You're going to see the Rocky Mountains, the Midwest, where a lot of the Canadian oil flows. Also, places like New Hampshire and Maine, those may be impacted because of refined fuel imports in those areas as well. But Goldman Sachs is saying if you do see a prolonged tariff war, then this will likely send oil prices down. That is because GDP growth will slow. You're also going to have lower demand for oil because of a trade war. Brad.
Ines, thanks so much for breaking that down and the dynamics at play here. Appreciate it.
Thank you.
Let's take a look at some of the market action. We are 90 minutes into the trading day. Stocks falling today. They were earlier out of the gate after President Trump announced the plans to impose sweeping tariffs on U.S. trade partners, even as the president confirms that tariffs on Mexico will be delayed for a month. So a lot at play, fast moving here, as is your portfolio. Joining me now is Katie Kaminsky, Alpha Simplex Group Chief Research Strategist and Portfolio Manager. All right, Katie, amidst the he loves them not in the tariff kind of mindset here, how should investors be managing their portfolios?
I think investors really need to think about we're in an environment where volatility is going to be higher. So first, they need to think about there's going to be a lot of volatility to manage. But secondly, they need to be thinking about the implications of tariffs on growth and long-term inflation. And so I think it's really going to be a question of, is this a short-term pain versus gain where things get better, or are we in a scenario where we have sustained long-term inflation issues?
And so with that in mind, where do some of the perhaps safe havens really emerge from your kind of scan across the landscape?
Yes. So if you're definitely concerned about inflation, some of the key areas to focus on or trends that we've seen that have worked well are things like the US dollar, so currency exposure, but also energy prices and other raw commodity prices have the opportunity to hedge and offset some of these moves. Another thing which has also been interesting is that people have been, in some sense, buying long-term fixed income, but the general theme for fixed income has actually been short because if you do actually see inflation rise, we're less likely to have rate cuts anytime soon. So I think it is tricky. It's really about hedging inflation in the short term and focusing on companies that are more resilient to some of these short-term inflation moves.
All these things considered, it comes at a week where we're going to get even more of the Mag 7 names reporting. That's been so much of the long trade that we've seen investors really flock to. What do you expect to hear from tech earnings that could set the tone, not just for the rest of this earnings season, but perhaps buoy the markets during some of the volatility that we are navigating through?
Yeah, this is a good point. I mean, as I was just saying, the larger companies that may be more resilient to some of these tariffs, if we can see strong earnings there, that will definitely give some support to the overall growth theme that we've been seeing for quite some time. So that's why those earnings are going to be an important pivot point to sort of tip the scales, whether or not this is tariffs and these type of discussions and trade war is a concern that might affect growth long term.
And so, as we're kind of thinking about the theme that has really been kind of the common denominator for some of those big tech earnings, it's been AI, it's been generative AI and how much they're investing into that. How should some of the viewers and those who have already kind of piled into this trade be thinking about the time period that they should be looking for some of those big investments on generative AI to pay off?
Oh, that's a very good question. I think if you think time frames, it can be tricky. If we start with shorter term, I mean, clearly shorter term, it's really seeing consistent earnings and a trajectory that makes sense for sort of to support the narrative that they've already sort of bought into. But longer term, as we saw last week, there's still going to be disruption and sort of a changing narrative of how AI continues to be impactful. So I think last week was a good wake-up call for many investors as well, that the narrative will continue to change and they're going to have to be sort of ready for that.
President Trump certainly uses the stock market as his barometer or as his North Star for success. Do you think that that will be something that gets factored in even amid some of the negotiations playing out on the tariff front?
Definitely the case. But what was interesting, there was recent commentary about sort of there may be short-term pain for long-term gain. So, we got to sort of ask the question of how much of this is negotiating and how much of it is sort of the time horizon they're thinking about. So I'd say, if it is the case that, sort of where we are right now is not as extreme in the long term, then sort of maybe this is all part of the negotiation tactics. So I'd have to say that it's really going to depend on what time horizon they're seeing this. So shorter term, less so maybe. So we'll see.
Katie, thanks so much for taking the time. Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got the Catalyst co-host Madison Mills here on set. First up, Maddie, we got to talk a little foods here. Tyson Foods raising its profit outlook for 2025. Chicken driving strong sales there. Shares right now up by about 2.9%. What do we make of these earnings, especially at a time where chicken and eggs certainly have so much of the avian flu conversation that has been driving those market dynamics?
And those are certainly known unknowns for impacts moving forward for Tyson Foods, but the sixth quarter in a row for this company to beat by double digits on the bottom line here. And you mentioned that uptick in EPS here, topping the consensus estimate by 26%. Analysts calling out strength in that chicken segment in particular, that 25% EPS beat, primarily driven by chicken and beef here. A little bit of weakness in other categories like pork, but nothing too concerning here, just not as big of an uptick as we saw in the chicken category. Some question marks moving forward here. Obviously, trade is a question. The impact of tariff policies and avian flu is another big question. That's pointed out by Bloomberg Intelligence analyst Jennifer Bartushis, who has come on the show previously. Also, Barclays maintaining their overweight status on Tyson, saying a beat from top to bottom as better chicken results coupled with a narrower loss in beef, offset any softness in prepared foods, which is interesting given that we have seen Tyson talking about this transition into more prepared foods. They may not have to invest as much in that moving forward, given the success they're having in their own bread and butter.
Yeah, I like that. You know, at the end of the day, too, I think for Tyson, it comes back to where their partnerships continue to hold strong as well. This is a company that sells in to so many of the fast food, or at least has partnerships with fast food entities that rely on some of Tyson's ability to really make sure that they're getting the nuggets into some of those boxes and bags. And so as there's a rush towards some of the value meals, I wonder how Tyson is threading the needle in some of those conversations as well on the corporate partnership side. While we have you here, we want to talk about another one too. Tesla registrations, they fell more than 60% in France, en français, last month. There were 1,141 registrations in January. That is the fewest since August of 2022, according to the French Industry Association, PFA. Shares of Tesla down here during trading by just shy of 5% right now.
And we should mention that is part of a broader sell-off that we are seeing in the tech stocks today, specifically the Mag 7, which Tesla is, of course, a part of. But you have to wonder what caused this degree of a plummet here. 63% move to the downside in terms of EV sales from Tesla in the EU's second biggest market for battery-powered electric vehicles here. It's a question mark as to whether or not the political leanings of Elon Musk could have anything to do with this. Obviously, France dealing with a lot of political upheaval at the moment, and the European Union more broadly having a slew of elections. Elon Musk throwing out his support for specifically an alternative for the Germany party and a far-right candidate. He posted on X, "Make Europe Great Again." It makes sense that he is getting involved in European politics given the success that Tesla had following the election of Trump, who obviously Elon Musk was a huge supporter of on the campaign trail. And if he's able to get more candidates in office globally, could that have the same impact on Tesla's stock? Remains to be seen, given that some of his political leanings could potentially be seen as headwinds to his company's performance, as you can see, is potentially what's playing out in France here.
Yeah, that's going to be interesting to watch, especially because the mindset typically in the European Union, or at least among consumers, is trusting government more than trusting corporations versus here in the U.S.
Yeah.
And so how that influence and that weight gets thrown around, that's going to be another major kind of spate of elections to watch going forward in his own kind of influence of political power overseas and across the pond. Maddie, thanks so much.
Thanks, Brad.
Appreciate it. Newly installed Treasury Secretary Scott Bessent will serve as the acting head of the U.S. Consumer Financial Protection Bureau, or the CFPB. This comes after President Trump removed Rohit Chopra as the director on Saturday. This leadership change-up may signal a shift for the consumer watchdog away from the aggressive approach under the previous administration. Bessent releasing a statement writing he looks forward to advancing the president's agenda to lower costs for Americans and accelerate economic growth. Under Rohit Chopra, the CFPB was issuing billions of dollars in fines and consumer compensation against a number of powerful firms, including Wells Fargo, Goldman Sachs, and Citigroup. In an open letter confirming his departure, Chopra urged the next director to continue some of this work, writing, "With so much power concentrated in the hands of a few, agencies like the CFPB have never been more critical." We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Investors have plenty of earnings this week to parse through, including results from some members of the Magnificent Seven, Alphabet and Amazon notably. Joining me now with her thoughts for big tech, Kimberly Forrest, Boca Capital Partners founder and chief investment officer. Almost gave you a nice little upgrade and promotion there, but soon, in due time. Kimberly, great to have you here on the program with us once again. Let's talk about some of these earnings results. Which do you believe is most critical for big tech to cement its weight, especially given this earnings season and the volatile period that the markets are navigating through?
Sure. Well, I think it's twofold, but they're in the same business, right? I think Google and Amazon, and both of those in their cloud services / AI delivery systems are pretty much in our target for answering the question, is this AI thing really for real? I'm kidding about that. But how much is it going to be rolled out and how profitable is it? That's always important for investors to know about. So those are the two that I'm watching the most closely this week.
Certainly. And so as you think about, and let's dive perhaps one by one here, and thinking through Alphabet for a moment, Alphabet earnings, that could set the tone, especially as it relates to all of the conversation around search and where search is shifting to and where people are leveraging some of the generative AI tools out there. What are you watching for with this report?
Well, a couple of things. The most important thing for Google is where it gets its money, and that's from advertisers. So we have to ask ourselves, are advertisers still getting value by buying AdWords or, the many ways that they can advertise on Google? And I think that is key. I used to be a practitioner of AI, so I know this space really well, and I'm still a little confused as to what problem it's solving. And it looks right now like it's a glorified search engine, as you kind of pointed out. And that, of course, would have direct bearing on whether or not Google is, in 5 years, as rich as it is now and able to do, these kind of one-off projects like Waymo and Gemini. So this is a really important time for them to make sure that they still have their mojo with respect to satisfying advertisers.
With that in mind, and there is that larger question to your point about where advertisements will get inserted into the new user experience of search with, and not just prompting, but also prompt and query with an output and a result that takes it one step further than, just kind of looking through an encyclopedia, but hey, write the report for me based upon what you found in the encyclopedia, essentially. Where does advertising get layered in on top of that?
Well, I think it's the driver. I hate to say this, but maybe 10 years ago when we were trying to figure out this whole Magnificent Seven kind of world, maybe it was Google and Amazon and other elements. Social media, of course. Mm-hmm. Advertisers really play in those spaces. And I was somebody that kept coming back to the fact that they are the paying client. Even though our searches and our postings on Instagram and maybe even Snapchat and Facebook, yes, they drive traffic, but dollars are being exchanged by advertisers. So they are going to be driving not only the results, but how they're delivered. And I don't think that's a small thing for people to forget.
Just while we're on the topic of Alphabet, they have this subsidiary, of course, not just Google, but a host of other ones, YouTube included. And YouTube is one area where they've been trying to go up against Reels and go up against TikTok and roll out more AI tools for creators. What's going to move the needle there and ultimately kind of cement where naturally we've already seen ads pop up, and for YouTube to cement its own AI play for creators that passes through to real revenue generation?
Right. Well, as somebody that uses it and I don't pay for it, I am annoyed beyond comprehension when the ad, it always comes at a point where I'm really paying attention to the product, right? So, I mean, that's great for advertisers, but it makes me not want to use the product. And I think being able to more subtly include those ads and yet satisfy those advertisers, I think that would be a real coup for Google to be able to pull that off.
Kimberly, thanks so much for taking the time here with us today. Always a pleasure to get some of your insights. A recent report from McKinsey shows employees are more ready for AI than leaders realize. Leaders surveyed guessed that only 4% of employees use AI for 30% of their work, but that number of employees is actually 3 times higher. And here to explain the discrepancy between how employers and employees feel about AI is Lorena Yee, McKinsey & Company Senior Partner and Global Head of McKinsey Alliances. Great to have you here with us. So first and foremost, let's just talk about the generational divide on generative AI here and how you're kind of classifying the acceptance of some of these technology and tools across different generations.
Well, one thing that's really surprising is what you started with, which is employees are actually far more ready for the changes in AI. As you said, they expect over 70% expect that 30% of their work or more will change with AI over the next 2 years. And whether they are super excited about it or very skeptical, they are investing in their own education, in their own ability to use AI. And a couple of things. One that's surprising is that of all the generations, millennials are most forward thinking in AI. Kind of bucks the idea that your youngest members of your employee group are the most excited. We see that millennials are stepping forward. A second thing that's really interesting is that employees are saying, look, this is happening, and I am hoping that my employer will invest in me. And we're not quite seeing this yet. They're skeptical that employees will invest in them, but they're really hoping they'll get the education, training, and on-the-job ability to use these tools in their work.
Lorena, as you think about where employers are looking to tap more into this technology, where are the first kind of roles and job functions that it seems like there's a natural fit for generative AI, either for in tandem work or, dare I say, replacement?
Well, for any work, one of the things that we know is the outer limit of the potential of generative AI is over $4.4 trillion of GDP value. So in a world where we're all looking for growth, this is enormously powerful. And that's a long-term statistic. That's over 1 or 2 decades. And what we know, interestingly enough, is 70% of that value is in 4 functions: marketing and sales, customer care, think about your call center when you have a question, software development, and product development. So the first roles that you might look at are those functions. But what's more important is that leaders are stuck in pilot purgatory. They're doing small experiments. And what we really need is for leaders to step up with greater creativity and imagination and reimagine domains of work, not just a single task, not just a single job.
And so with that in mind, how could we be looking at a reconstruction of that employee-employer relationship from what you've been looking across and studying?
Well, some of the best companies and some of the ones that are really forward-leaning on this, they're including their employees in the process of developing the solutions. I talked to one CTO, amazing story, where they did all these hackathons. And, you know, whether you're positive or negative on hackathons, some of the best ideas come from your employees. And one of the teams was a procurement team. And they found through using these tools, they could save the company millions of dollars through kind of contract penalties that the company didn't even realize that they were incurring. So one of the things is that your hidden gem are your frontline employees, are your managers, and they are ready for AI. They may not love it, they may love it, but irrespective, they are ready to start walking into this age.
And so with that in mind, I mean, as we're thinking about who's feeling good about AI and who's not, there also comes the kind of performance around it. What is the real delta that companies are looking for as they are implementing any type of AI into their workforce?
Well, the first thing they're looking for is investing more. We saw in our work that over 92% of companies will increase their AI investments. But it's not just about what you put in, it's what you get out. And so the question is, how much ROI are you getting? And back to this earlier point, if you're just doing pilots, you're not going to see a change in your quarterly earnings. You actually need to transform the work itself. And, you know, that's where you start to see 5, 10, or more % change. And that's when it starts to have a material value. But you have to start with an aspiration. And one of the interesting things is we saw it's not just that leaders need to have a vision, but they need to align their teams. And some of the most traditional challenges that we've had in any IT automation or any IT revolution are here with us today. You need to align your team, stack hands, and start moving.
Lorena, thanks so much for taking the time here with us today.
Thank
Really
you
appreciate
so
it.
much.
Certainly. Coming up, everyone, we'll dig further into how tariffs could affect the economy and your finances. Stay tuned. President Trump's tariff announcement is causing strategists and economists alike to rethink their short-term and long-term views of growth in the U.S. Our next guest says tariffs could lead to lower growth, higher prices for goods, and will provide little benefit for the federal budget. Here to discuss the policy's impacts, we're joined by Dana Peterson, the Conference Board Chief Economist. Dana, great to have you on the program with us. Let's just break down the will they, won't they of tariffs that we've seen thus far and the longer run economic impact as we should be gauging it.
Sure. Well, we know that the tariffs so far have been used as kind of a threat to economies, including China, Canada, and Mexico, for the administration to get at different aims. Certainly those aims around security, national security and drugs and those kinds of things. But nonetheless, if these tariffs do go into place, we could see much lower GDP growth in the U.S. as well as in the target economies and faster inflation.
And so with that in mind, as we're thinking about the negotiations that are coming forth, even in the midst of all of this, where should we be watching for certain categories to also have a larger impact on the way that the consumers are thinking about any tariffs that would be implemented?
Absolutely. I think in the Q4 GDP growth data, we did see a surge in spending on things that might be very expensive once tariffs come into place, things like cars and white goods, but also consumers stocked up on things like food. And certainly when we look at the tariffs that might be put into place, the U.S. imports a ton of food items, grocery items from Mexico. And also when we look at the auto sector is integrated across all three economies, Canada, Mexico, and the US. And so we could see those prices rise and consumers really think twice about what they buy. And certainly the substitution effect will take place, but that could take time as consumers figure out, well, where can they buy US made products?
And then just lastly here on this topic, as we're thinking through where the US, Mexico, Canada have the most negotiation that they need to do going forward, it's also China that's thrown into the mix as well. Where might we see larger impacts based on what we've seen before kind of filter through to things like energy, filter through to everyday costs for consumers, as now you would have what's old is new again in renegotiating once again with China?
Sure, absolutely. With China, the biggest risks are definitely around technology. The U.S. imports a lot of products from China. Even though the intellectual property may be here in the U.S., things like cell phones get assembled in China. And certainly we could see more expensive items that involve technology. And also China is a key source of semiconductor chips. And we know that computer chips go into just about everything. So we could see these tariffs filter through to the costs of many items, not only groceries and gasoline, but certainly a lot of the high-tech goods that consumers have become accustomed to using.
Dana, shifting gears here. In honor of Black History Month, Yahoo Finance is speaking to a number of leaders across corporate America, and we're spotlighting leadership lessons and wealth building tips for the next generation of investors and business decision makers. And Dana, we have a pleasure to speak with you throughout the year, especially when that consumer confidence number gets printed by the Conference Board. You're one of the voices that gets heard from, as you've gotten not just a read in on this data, but it's also your quote that goes into those reports as well. You know, I would love to know from you some of your top leadership tips for future innovators, investors, decision makers who aspire to be in a similar position one day.
Sure, absolutely. I mean, the one thing is that great leaders have to be innovative and visionary, but they also have to be willing to roll up their sleeves and jump into the deep end and into the trenches with the folks that they're leading. And certainly it's inspirational leadership that encourages your staff and the people who work for you to get out there, try new things, because they know that you will have their backs and you will be in the deep end with them. Another thing I think is important, that leaders must combine EQ with IQ. Yes, leaders are brilliant, but they don't know everything. So certainly you have to do more listening than talking sometimes, and take in the perspectives of many different voices. And so once you have that data plus different perspectives that may not line up with what you think, you can make much better decisions. And finally, it's important for leaders to give back. You never know who you might inspire through your teaching, your mentorship, and also your sponsorship. And certainly none of us have gotten to where we are by ourselves. So it's important that we reach back and help others.
Great insights on the consumer and great tips and leadership lessons for future business executives out there as well. Dana Peterson, thanks so much for taking the time.
Thank you.
Coming up, we have advice for retirees on filing their taxes ahead of that April 15th deadline. That on the other side. A nationwide retirement institute study found that 37% of retirees were unaware of how taxes would impact their retirement income. There are lots of reasons you might be looking forward to retirement. Oh yeah. But paying your taxes, yeah, it's probably not one of them. Seniors and retirees have special tax situations that you might not be aware of. Nick Holman, Betterment Director of Financial Planning, is here to break them all down. Good to have you with us, Nick. So let's start with retirement saving. What are some of the retirement accounts that all taxpayers should be aware of, especially as they're making sure that they're adding to right before April here?
Well, first off, thanks so much for having me, Brad. When it comes to retirement savings, even if you're retired right now, if you had earned income in 2024, it's not too late to contribute to some key retirement accounts that can even help lower your tax bill. I know we're into 2025, but there's still time to contribute to IRAs and or HSAs. And depending on whether you're single or married, that can lower your tax bill by thousands of dollars.
So what's the biggest mistake that retirees make when it comes to their Social Security and taxes from what you've seen?
Yeah, there's a few key things specifically around Social Security taxation that a lot of retirees are not aware of. One of those is that your Social Security benefits are actually a very tax efficient type of retirement income. Not 100% of those benefits is going to be taxed. So that's much more tax efficient than, say, withdrawals from a 401k or an IRA. Because of that, one key decision that you might want to look into is delaying Social Security, which will boost the amount of your Social Security benefits and give you that much more tax advantaged income. Another thing to keep in mind is that you want to set up tax withholding from your Social Security benefits. If you don't do that, then you're not going to be paying taxes throughout the year, and you might get hit with a big surprise tax bill come next tax filing season.
Nick, I wonder, is there a right way to withdraw income from your retirement accounts to minimize the taxes that you'll have to pay?
100% yes. This is actually a topic we've been doing a lot of research on recently. A lot of retirees are unaware that the order that you start to withdraw from your different retirement accounts can have a huge impact on your tax efficiency, but also how long your overall retirement portfolio will last you. And if you do it smartly, you can extend how long your investments last by multiple years. Specifically, what we've been doing, it's kind of tough because even industry experts don't always agree on which order you should draw down your retirement accounts. So my team's been doing a lot of research here, actually using some AI to analyze some industry best practices and trends. The one key takeaway that I'd recommend to all the viewers is it's called bracket filling. So what you're going to do is you want to take advantage of those low tax brackets. If you find yourself in a year where you're in a lower income than usual, consider things like early withdrawals from your IRA accounts before RMDs kick in, and or considering Roth conversions to take advantage of those low tax rates while we have them.
What is the net impact that you're anticipating from a Trump Tax Cuts and Jobs Act 2.0 for retirees as they are filing, not this year, but I guess in future years?
Yeah, there's a lot of tax cuts from the first Trump administration that are set to expire in 2025. And generally speaking, that's going to mean higher taxes after they expire across the board. That's going to mean things like higher tax rates, lower standard deductions, and more people being subject to AMT or alternative minimum tax. So you want to try to plan ahead for that. But what I would say is I would strongly caution retirees from making any drastic financial moves based off of their political crystal ball. Lots of people expect that many, if not all, of the cuts will get extended by Congress and the current administration. But I'd say that predictable is not one of Donald Trump's adjectives. So be tight, sit ready, be ready to move, but don't make any decisions yet until we're a little bit further into the year.
You're correct. That's definitely not his mood ring, predictable. Nick, thanks so much for taking the time here with us. Really appreciate it.
Thank you, Brad.
Coming up, are Super Bowl tickets in your budget this month? Our next guest will give you the play-by-play on the best day to purchase those tickets ahead of Sunday. We're talking financing your fandom next on Wealth.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
A programming note. In this week's episode of Financial Freestyle with Ross Mack, former NBA player Evan Turner discusses collaborating in business.
As a person that used to be an NBA player, I think the number one thing in regards to business I want to identify myself as is a collaborator. I think that's one of the things that I've noticed, and I've always tried to set the tone for when I talk to people about business. It's like, hey, you can't do everything on your own. Figure out ways to collaborate. And when I meet other business individuals, it's like, well, what are you about? And it's like, well, I did this, I did all this cool stuff, but I'm a collaborator, like meaning I'm tucking my tail and being like, hey, I want to work, figure out ways and solutions to work and see how we can help each other and make the bigger moves.
New episodes of Financial Freestyle air Mondays at 12 p.m. Eastern Time. You can catch them on Yahoo Finance or wherever you get your podcasts. The Super Bowl is usually the most watched U.S. television event of the year. But if you're dreaming of seeing the Kansas City Chiefs face off with the Philadelphia Eagles in person, it may not be too late to grab a ticket. Here with everything that you need to know about Super Bowl ticket prices is Brad Griffith, the CEO of last-minute ticket site Game Time. Brad, great to have you. I will say that I've been tracking the ticket prices on Game Time as a Birds fan, and even me bringing up the prices at home was less than favorably receptive. But anyway, all those things considered, I'm still going to keep an eye on it. It seems like prices have started to come down a little bit. When is the right time to really get in on that deal?
Hey, Brad. Congrats on the Birds, and thanks for having me on. Yeah. Today, we're seeing prices at $43.39 to get into the game, a couple ticks lower than $4,700 just a couple days ago. My personal preference on the Super Bowl is 2, 3, 4 days ahead of time, so you still have some time to watch the prices. Day of, also doable. It tends to be a little bit stressful for the Super Bowl. Pretty much any other event, day of tends to be the right time.
I wonder what you're seeing. You're one of the platforms that also has the ability for fans to kind of finance their ticket payment through buy now, pay later or in installments. What are you seeing in terms of this season and the number of consumers out there that are trying to finance these purchases over time or spread out those payments?
Yeah, we'll see mid-single digit user percentage using buy now, pay later, as you're saying. It's been ticking up a little bit year over year. But certainly an interesting option for prices this high is buy now, pay later.
I wonder, since you founded the platform here, the growth that you've seen for Game Time, what some of the strategic initiatives are for continued user engagement, now knowing that consumers are really looking to try and get more affordable options for their ticket purchases.
Yeah, so we launched Game Time to solve our own problem, which was buying last-minute tickets. Tickets have this depreciating asset property where they're going to zero value at the end of the event. And so it can be a good ability to be able to buy at the last minute. But more recently, we've been focused on an initiative we call Game Time Picks. So in the bright green, if you go to gametime.co, in the bright green, you'll find the best values in the entire stadium. And then in other green colors, you'll see very good values. So what we've been trying to do is highlight the best value for the fan and the customer, and Game Time Picks sort of algorithmically does that for the fan to save you time and money. And so we started all in on mobile and recently have been building around this ML sort of AI frontier for Game Time Picks.
You know, bringing this back to the Super Bowl for a hot second, how do ticket prices this year compare to what you've seen in years past?
Yeah, so I was there in Vegas last year, watching prices myself. Prices this year, though, about 20% lower than last year's game. What tends to happen is if you have repeat teams like the Chiefs and like the Birds, congrats again, people who have maybe spent their money in years past, and prices will be lower. So yeah, we're seeing prices down from Vegas and down from years past. So if you're looking to go, it's a great year to go.
And so all of these things in mind, I'm looking at some of the top price seats. It seems like, you know, in the tens of thousands here. So are you anticipating that we will continue over the next few days to see prices either decline further, or might they get a little bit higher as we get closer to the game?
Supply and demand is a very hard thing to predict. My estimation is prices will fall through about 2 days ahead of the event. Last year, we saw prices gain about 10% during the day of the event. So on Super Bowl day, prices went up. So again, very hard to predict, but if it's like years past, I expect prices to fall over the next 6 days and then maybe gain in the final day.
All right, so you're telling me to just book a flight to New Orleans and just get down there and then see what happens. All right, I hear your advice. Brad, thanks so much.
Thanks, Brad. Appreciate it.
Likewise. Let's do a final check of the markets here. We're taking a look at the major averages here. It has been a volatile day here to start off the trading week. As we're taking a look at the Dow right now, it's down by about 0.25%. The S&P 500 lower by 0.7%, and the Nasdaq, that's lower by about 1.2%. You got some Mag 7, two of them, and Amazon and Alphabet certainly going to be catching some attention from investors this week when they report earnings. That's it for Wealth. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time. You don't want to miss it.
It's time for Yahoo Finance's Market Minute. Stocks moving to the downside still, but paring earlier losses after President Trump confirmed tariffs on Mexico will be delayed by 1 month. Bitcoin trying to claw its way back to positive territory, hovering just around $99,000 as investors digest that tariff news. Associated stocks, Coinbase and MicroStrategy still lower, but recovering some of their earlier losses as well. Shares of Tesla are lower as tariff news weighs on automakers. Tesla seeing declines in Europe. Tesla's registered in Sweden down 44% from a year ago, 38% in Norway, and 60% in France. Elf Beauty under pressure in part due to investor Hodges Capital Management cutting its stake in the company by over 26% in the fourth quarter. And that is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.